Everything is expensive right now. We should expect lower returns across the board, both from stocks and from bonds.
When I look at the S&P 493, there's a lot of businesses in tech hardware.
You don't want to have a scenario where tech and tech capex slows down.
We saw a really good earnings season, and some of that has been baked in NVIDIA stock.
It's starting to feel to me like we are paying 20, 30 prices for 2025 technology.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, one stock dominates. Tech giant NVIDIA gearing up to report earnings after the closing bell as investors look to shut out the drama surrounding the Federal Reserve, the White House, making a move to slap a 50% tariff on imports from India. The tension continues to build.
There's still a lot of questions that basically remained unanswered. Not really sure where the solution is going when it comes to the Fed. How is that going to be wrapped up in terms of the courts? When it comes to tariffs on India, this additional 25% tariff on imports from India coming into the United States. Jonathan, is that here to stay, or is this administration still in negotiating mode? And then when it comes to NVIDIA, the key question on the earnings call is going to also be about policy. How has policy in Washington affected their business, especially critically when it comes to China?
You mentioned the Federal Reserve, so let's start with the Federal Reserve. If I was worried about the total erosion of central bank independence, the emergence of absolute fiscal dominance, I'd be looking for some serious dollar weakness. Didn't see it yesterday. Don't see it this morning.
Because it's going to the courts. And at the end of the day, the courts are going to rule on this. So it doesn't feel like the president has ultimate absolute power when it comes to the Fed. That relies in Congress, and it's going to go to the courts. We're hearing that potentially as soon as this week, Lisa Cook could file for injunction, which means she could still be working, which means she could still be at the Fed meeting in September, and potentially she is lining up on the dovish side.
If things could get awkward and get awkward very quickly, the latest reporting from the team here at Bloomberg is that the president is pushing for a majority on the board, and there's talk of this extending to more scrutiny of regional Fed presidents, something that's come up in conversation a few times.
Right, because basically it's the board that's going to decide about how they want to maybe revamp, give the renewal to the president. And the president yesterday, Jonathan, I was in a 3-hour, 16-minute cabinet meeting. The president was asked a few times by me and others about what is going on at the Federal Reserve. And he said, next year, I'm looking forward to it. We're likely going to have a majority. And that means when it comes to rates, they'll be coming down. Something the market should also be focused on. Next week, we reported last night, the Senate Banking Committee back in session. That hearing for Steve Myron set to take place. Now that's going to be an absolute litmus test for Democrats and even some Republicans asking him about he thinks about Fed independence.
That decision, September 17th, just a few weeks away for the Federal Reserve. Equity futures this morning, with this far away from all-time highs on the S&P 500. Futures this morning positive by not even 0.1%. Coming up this hour, we'll catch up with Iain Stealey of JP Morgan with the bond market on edge. Angelo Zino of CFRA looking ahead to earnings from NVIDIA. And we'll catch up with the former Trump trade official, Kalutkiewicz, as 50% tariffs on India kick in. We begin this out with stocks and bonds a little changed as investors weigh President Trump's pressure on the Fed. Iain Stealey of JP Morgan writing, this remains a good environment for owning fixed income. Yields are still high relative to the last couple of decades, and the bar to cut rates is much lower than the bar to hike. Iain joins us now for more. Iain, welcome to the programme, sir. Is it a good environment to own treasuries?
It does feel that way, doesn't it? Because I think the big thing that happened over the last week was Jerome Powell opened the door for the rate cut in September. Obviously, there's a lot of data coming up, both jobs and inflation between now and then. But it does feel as if that's the direction of travel. It's what the administration are after. Yields still look elevated versus where they've been, as I said, over the last couple of decades. So it does feel like we're in an environment where owning bonds makes sense. And I think there's an asymmetry in doing so.
So, Iain, let's build on that. I know a lot of people in your camp that like bonds, but there are limits on how far out they want to go along the curve. Do you have limits as well?
I think you have to have limits at the moment because ultimately you've got the Federal Reserve, which is going, well, it does look like they're going to be lowering rates. Let's figure out over the next couple of quarters by how much. That's going to impact the intermediate part and lower. And then you've got the long end, which is being confronted by the fiscal situation, being confronted by questions around Fed independence. So I do think the steepener trade makes sense. Understanding it is a very crowded position. It's moved a long way over the course of this year, but I have got more confidence in owning shorter dated intermediate bonds rather than the long end. And I think that's not just a US phenomenon, that is a global phenomenon at the moment.
Iain, are you surprised, though, about somewhat of the muted market reaction if the investors are really concerned about Fed independence?
I think I am, but when I take a step back, I think there's a big question between having, as President Trump said, a majority within the Fed who are maybe more dovish, but then reacting to the stage of how dovish actually are they? Because ultimately the Fed is on an easing trajectory. If you see rate cuts that come, maybe we get 1.25 for the next few quarters, I think that's okay. The market's actually happy with that. That's probably in line with expectations. I think the bigger concern is if it looked like they were going to take rates down by the 350 basis points or so that had been asked for previously. And I think that would be considered outside of what the market and what the economy needs at the moment. I think that's when you would get more concern around Fed independence. And I think although you've obviously got some dovish people in Bowman, in Waller, on the Fed at the moment, are they really dovish to that extent, or do they just think some of these maintenance cuts are needed? And I think that's what the market is hanging itself on the moment. And I do agree with John. I'd have maybe expected a bit more volatility in things like the dollar. But ultimately, if it's just that trajectory, I think that's why we're holding up at the moment.
And I just want to extend that thought. Just a couple of beats. I think this is really important. The next decision in some ways is an easy one because most people on the Federal Reserve believe we're still quite restrictive. If you look at Fed funds relative to what they think neutral is. And I want to understand from your perspective when that decision gets a little bit harder, when that conversation gets tougher for this Federal Reserve.
I think it's going to get tougher into next year. So if you take rates down by 50 basis points, 75 basis points, you're getting in the 3.5% range. I think that's okay. The market's willing to absorb that based on what's happening with the labour market at the moment. If you're seeing actually a stabilisation in the economy, maybe even a little bit of a re-acceleration at the same time as we still have inflation north of 2% and above the Fed's target, I think that's when questions will be called as to whether they need to go any further. And we're not going to know that. And ultimately, we are going to have to see the data. I think a lot of people are forgetting that although we've been talking about tariffs since the beginning of April, they've really only properly been in effect over the last couple of weeks or so. So I do feel it's going to be very data dependent. I feel you're completely right. The next couple of meetings is probably reasonably straightforward from a Fed standpoint. Into next year, it's going to become more challenging.
Well, Iain, let's stay on inflation. I think this is really important. The chairman in his speech in Jackson Hole on Friday suggested that we could see a one-time effect, but not all at once. And I think a lot of people walked away with that, thinking that the runway now is a lot longer. This could play out over a number of quarters. And this was the chairman setting up the Federal Reserve to ignore hotter inflation prints. Was that your interpretation of what was happening?
Yeah, no, that was exactly the way that I think he laid it out. He talked about that the balance of risks have now moved from the inflation market, which is what I think I heard at his press conference back in July, to the labour market. And obviously the 258,000 reduction in jobs, the revisions there, that's obviously been a big concern. We'll be really eagle-eyed, and the market will be really eagle-eyed on next week's jobs report. Do we continue to see a deterioration, a slowdown? Do we continue to see backwards revisions, which actually maybe means the labour market was in a worse place than even we're thinking at the moment? Or do we start to see a bit of a stability, a bit of a maybe even a re-acceleration? That's going to be what's really interesting. But I definitely think he's moved the conversation away from the inflation prints to the labour market, at least in the near term, which means even if we do get a sort of a hot print for the next CPI report, maybe that won't be enough. Maybe it's going to be more around the labour market for at least for the next couple of prints or so.
Well, the president yesterday in this cabinet meeting said the next jobs report is going to be good. What happens if we actually get a very strong NFP number?
I think that's a really interesting question, because I think even with a sort of 100,000 or 150,000, the 3-month run rate is still going to be tracking at what most people perceive to be the neutral rate. And I think actually figuring out the neutral rate, given what's going on the supply side, is quite difficult at the moment. But I do think that's going to call into question, if you get that 150,000, maybe the unemployment rate ticks down at the same time as the inflation print the week later is a little bit elevated. That is definitely going to cause a lot of debate around the table at that September meeting.
Mike Gapon of Morgan Stanley's got an answer for that. So Mike was basically looking for no cuts in 2025. Now he's looking for a move in September. He said payrolls of 225 in August and another clear acceleration in tariff-related inflation could keep them on hold. Imagine how controversial, Annmarie, that would be if on September 17th, this Federal Reserve did not cut interest rates.
Absolutely controversial, especially given the fact that you had the Fed chair come out and open the door. But also, that's going to give Jay Powell political cover. He can point to his speech politically in Washington and say, look, I opened the door to cut rates. Not everyone was with me in following behind.
I can give you a sneak peek of the estimate for September 5th. So next week, believe it or not, 80K is the median so far. Those estimates are going to keep pouring in. That's the issue on the States side of things, Iain. I want to finish on the European side of things. The disruption in France. The disruption in France is causing more market havoc than anything happening here in America in the last 24 hours. Iain, looking at what's happening with French equities, what's happening with the French bond market? How much fiscal space do they have? And how long do we have to wait until the French government actually makes a move to do something about spending and taxes?
And that is the problem. And actually, it's been a continuing deteriorating story over the last few months or so. And it's exactly what the Prime Minister wants to do, is to try to create some of that fiscal space and improve that fiscal situation that France is in. Now, unfortunately, as we know globally at the moment, politically, it's very difficult to make those decisions. So that's the problem he's facing at the moment. He wants to bring that fiscal deficit down. It's north of 5%. He wants to get it to more close to 4.5%. The rest of the government don't seem to be in agreement with that. So it looks like we are going to fail the vote of confidence back on the 8th of September. And then we're going to be talking about another prime minister possibly, or even a re-election. And it's obviously causing more turmoil in the equity market, but it is causing a little bit of uncertainty in the government market. We have seen French spreads relative to Germany widen. We're close to 80 basis points at the moment. They're approaching where Italian spreads are. Would you believe it? I think back to where we were at some of the other tough times from a French standpoint, we've got to about 85 basis points. That feels like a reasonable level to start thinking about looking at opportunities there, because ultimately that's a relative to Germany. And if you remember, the fiscal situation in Germany is going to be worse than it was back then, with all the spending and all the issuance they're going to have to do. But it's definitely causing a little bit of uncertainty in French government, so I would prefer to own Italy at the moment.
More faith in Meloni than Macron. Iain Stealey at JP Morgan Asset Management. Iain, my words, not yours. Don't worry about it. Euro dollar this morning, negative by 0.4%. Not seeing that dollar weakness this morning, seeing some dollar strength, euro weakness. That currency pair 115.89. With an update on stories worldwide with your Bloomberg brief, let's cross over to Yahara Anand for more. Hey, Yahara.
Good morning, John. President Donald Trump said he's prepared for a legal fight with Fed Governor Lisa Cook after he attempted to fire her, while Cook's lawyer vowed to file a lawsuit over Trump's move. The Federal Reserve says it would abide by any court verdict and deferred any decision on Cook's current working status. Meanwhile, the president slapped a 50% tariff on Indian goods to punish the country for buying Russian oil. The new tariffs took effect at 12:01 a.m. this morning and will affect more than 55% of goods shipped to the U.S. Key exports like electronics and pharmaceuticals are exempt, sparing Apple's new factory investments in India for now. And Taylor Swift is getting her own Super Bowl-sized ring from Kansas City Chiefs tight end Travis Kelce. The pop star announced their engagement on Instagram yesterday, and news of their nuptials sparked a flood of online bets, including wagers on a possible wedding date and when the couple might have a baby. A bit aggressive. That's your Bloomberg brief. John?
Just a little bit. Yahara, thank you. Appreciate it. More from Yahara in about 30 minutes' time. Up next on the program, gearing up for a legal battle.
Fed Governor Lisa Cook, her lawyer, has said that they're going to be filing a lawsuit challenging this legal action. What is your response? Are you prepared for a legal fight?
She seems to have had an infraction, and she can't have an infraction.
That conversation up next with Eswar Prasad of Cornell University. Live from New York City this morning. Good morning. Three days of gains for Nvidia coming into earnings day. Nvidia this morning at the pre-market positive again, up by 0.6%. Expectations sky high, looking for a 48% jump in earnings from the previous year. A 44% increase for revenue from the same quarter a year ago. That bar sky high once again for that stock. The broader equity market doing okay. Equity futures positive by close to 0.1%. Very, very close to all-time highs at the close yesterday. Nasdaq futures this morning just about unchanged. Under surveillance this morning, we're gearing up for a legal battle.
Fed Governor Lisa Cook, her lawyer has said that they're going to be filing a lawsuit challenging this legal action. What is your response? Are you prepared for a legal fight?
She seems to have had an infraction, and she can't have an infraction, especially that infraction, because she's in charge of, if you think about it, mortgages, and we need people that are 100% above board, and it doesn't seem like she was.
So here's the latest this morning. The Fed responding to President Trump's attempt to fire Governor Lisa Cook, saying it would abide by any court decision on whether he has that authority. Bloomberg's Tyler Kendall joins us now for more. Tyler, what's the latest?
Yeah. Hey, John. Good morning. Well, at this point, it doesn't appear that the White House is going to let up its pressure campaign on the central bank, with President Trump saying that he is prepared for this legal fight, telling Annmarie yesterday in the cabinet room that he will abide by any court decision. And that's really the big focus here at this point, because we know that there is a very high legal bar for the president to remove a Fed official. In fact, it was actually a protection that was bolstered by the Supreme Court earlier this year. You'll recall the High Court had heard a pair of two cases related to other officials that had been fired at other independent agencies. And the court ruled that the president was allowed to oust those officials, but had actually implemented essentially a shield for Federal Reserve officials, citing the Fed, the central bank's monetary policies, and what they called the unique structure. Of course, President Trump here would have to prove what's known as cause. The thing is, that cause isn't explicitly defined, though it is taken to mean historically to be malfeasance or ignoring a neglect of duties related to the job. Now, of course, we should say it's important at this point. These are just allegations against Fed Governor Lisa Cook. No formal charges have been brought, and her lawyer does say that they're going to challenge this in court. John, the next step that we're watching for, of course, here has to do whether or not she files for that injunction, which could mean that she's reinstated immediately as this court process plays out, which could mean that she could be there for that September FOMC meeting.
Tyler Kendall with the latest. Tyler, thank you. And could be voting for an interest rate cut based on recent communication.
Which is why this is going to be incredibly awkward, because this is someone the president is trying to oust, but actually she'd be doing what the president has been asking Jay Powell and the Fed to do for months.
Let's extend the conversation. Eswar Prasad of Cornell writing the following. The president has now declared open war on the U.S. institutional framework, which underpins the dollar's dominance in global finance, as well as other aspects of U.S. financial supremacy. Eswar joins us now for more. Eswar, welcome back to the program, sir. Let's just take your line of thinking. If we have declared open war on U.S. institutions, where are you seeing signs of damage?
So if one thinks about what are the key elements of the institutional framework that, as I mentioned, have underpinned the dollar's supremacy and foreign investors' trust, particularly in the U.S. financial system, it includes a system of checks and balances that is institutionalized, the rule of law, and most importantly, an independent central bank. Each of these elements of the U.S. institutional framework, took some dings during the first Trump term, but during the second term, Trump is really taking a hatchet to each of them. None of the checks and balances, either from Congress or to some extent from the judicial system, seem to be working very well. The Fed's independence is really crucial, and I should emphasize that it's operational independence. No Fed central bank can be ultimately free of political influence because, after all, it has to serve the welfare of the people. But in the operational decision making, all evidence seems to suggest that leaving the central bank alone to do its job is the right thing, makes it most effective and credible, and that's what Trump is attacking.
The Fed said that they would abide by what the court decides. I read that statement to the president live in the cabinet room when it came out and asked him, would you abide by the courts? And he says, yes, of course he will. So if the court decides that Lisa Cook can stay, is the damage already done? Or do you think that then just bolsters the view in America that we do have independent institutions?
Well, at the moment, I think a great deal of damage has already been done because Trump is very clear that he wants to bend every institution in the U.S., including a statutorily independent one like the Federal Reserve, to his will in terms of policy making and the broader elements of policy that need to line up with his desires. And that's not quite, what has helped America maintain its financial supremacy. It's a sense that everybody, including the government, has to play by the rules. We may not like the rules, but whether you're a domestic investor, a foreign investor, or the very government that sets the rules, you have to play by the rules. And that is the element that Trump is attacking. Now, even in a system where you have the rules very clearly laid out, ultimately it is norms that matter, because you cannot really write a rule that covers every eventuality, every circumstance of the world. And those norms are certainly being shattered. And this is, I think, the real concern, because even if Lisa Cook does stay on the board, a certain red line has been crossed. Trump has made it very clear that it is loyalty to him and his policies that matters much more than technical competence, even in an institution that is supposed to be largely run on technocratic grounds.
What does happen, though, if, as the DOJ said last week, they're potentially going to investigate this? What happens if Governor Cook is convicted of mortgage fraud? Does she belong there?
So this is, a really ugly matter, and it is going to get uglier because we are seeing that these allegations seem to be swelling up without much of the evidence being presented. And of course, once the evidence comes out, things will become a lot clearer what the intentions were, what the motives were. And as your colleague pointed out, the definition of cause is very important here. Trump has argued that Lisa Cook is one of the overseers of the mortgage market, and therefore any malfeasance or even the notion of malfeasance there is enough to be considered cause for firing her. But the question here is whether the real cause should be in terms of her incompetence when it comes to monetary policy issues, or some much deeper issue of malfeasance, which certainly has not been established yet. But whatever it has certainly put the Fed on notice that every one of its voting members is going to be subject to very careful scrutiny, which perhaps is not by itself a bad thing, but in a potentially very ugly way, being held to standards that certainly deviate from the past.
Eswar, I agree that this moment is ugly. I would also suggest, in the same way that you have, it's very difficult to discuss because we are hearing about the allegations, but no formal legal investigation has been opened. At the same time, Governor Cook hasn't exactly denied anything that's been alleged, which makes it equally as complicated. Eswar, I'm trying to understand how different this moment is to a moment we had a number of years ago of a financial disclosures of Federal Reserve officials who later resigned themselves because it became a distraction for the institution. Why do you believe this moment is different?
I think Lisa Cook is making a very important stand because without the evidence being clearly revealed, and in the case of the other Fed officials, there were allegations initially, but ultimately they resigned when the evidence did come out. So at this stage, we do not have any clear evidence yet. We have a bunch of allegations by one Trump administration official, and these have largely been intermediated through the platform X. So I think the real issue is whether there will be a process that is allowed to take its course. So rather than firing on the basis of this allegation, if it was a situation where the evidence was clearly laid out so we could all see it, and then the ramifications were teased out, and then the president took action, it would be a very different thing. And of course, the context is very important here. Trump has been attacking the Fed. He's already made comments about Lisa Cook not having, done what he thinks she and other members of the Fed board should have done, which is to cut interest rates quite aggressively. So there seems to be a mix of these allegations plus what he considers malfeasance in terms of not following his policy wishes. So I think that's one of the reasons why Lisa Cook might be making a stand. And of course, we still need to wait and see how the evidence plays out.
Eswar Prasad, I think we've all got to wait and give it space for due process to carry out. Eswar Prasad there of Cornell University on a very messy situation down in Washington.
And it's going to get even louder because really when Steve Myron goes in front of the Senate Banking Committee, this is going to be all the questions. It is all going to be about Fed independence, and they're going to read back what the president said yesterday. Next year, we're going to have a majority at the Fed, and I'm looking forward to that. His words.
More still to come on this conversation. Up next on the programme, a lot to talk about with regards to this stock right here, NVIDIA. Angelo Zino of CFRA will join us with his bullish call on the stock. Plus, Danny Berger has your morning movers. Eli Lilly shares rising as its weight loss pill nears approval. It's the main event later on this afternoon. NVIDIA, 3 days of gains coming into earnings day. NVIDIA this morning positive by 0.65%. 8% of the S&P 500 makes up 10% of the Nasdaq 100. The fate of these markets in the hands of that earnings report later on this afternoon. Equity futures right now in the S&P 500 positive by not even 0.1%, getting closer and closer to another record high at the opening bell 3 hours from now. As we count you down to that opening bell, let's get you some morning moves and cross back over to Danny for more. Hey, Danny.
Hey, John. Another really strong day for Lilly. At least that's how it's shaping up in the pre-market. Yesterday, these shares saw their biggest gains since the post-Liberation Day bounce back in April. Now they're up another 1.5% today. The rally has been fueled by a recent trial they did over an obesity pill, not an injection, a pill where people lost 9.6% of their body fat, getting it one step closer to getting approval, being the first in that market. Elsewhere, we're seeing Rocket Aerospace, the rocket company, those shares up 4%, saying it's gotten clearance from the FAA to yet again resume rocket launches. They had a launch earlier in the year that did not go as planned. It exploded. The FAA had to investigate. They say that they know what went wrong and can remedy it. And now they're looking for a window for their next space launch. Finally, looking at some of the software companies this morning after we had some earnings after the bell, specifically from Okta and MongoDB. Both of those companies, a raise and a beat. They're both on the smaller side, under $5 billion. But Snowflake, that's the big one in this space. It's rallying in sympathy, up 4.5%. And we'll also get their earnings after the bell today, John.
Danny, thank you. Appreciate the update. More from Danny in the next hour. On our radar this morning, President Donald Trump gearing up for a legal fight to oust Fed Governor Lisa Cook. Cook's lawyer vowing to file a lawsuit to challenge the action. Trump and the Fed saying they'll abide by any court decision.
So if they're going to abide by the court decision, the next question becomes, will Lisa Cook have the basic confidence in the public? And this is what the Treasury Secretary was getting at yesterday in the cabinet meeting. He wasn't asked a question, but they went around the room, and something he said was that the Fed's independence comes from a political arrangement between itself and the American public. Having the public's trust is the only thing that gives its credibility. So basically, does it become so untenable for Governor Cook, even if she's able to stay at that position, that maybe she has to actually think about resigning? And that is why there is concern amongst a lot of economists about this pressure building on the independent Fed.
We should certainly let the legal process play out, but let's just build on the independence of the central bank. Huge proponent of central bank independence. So let's defend it, and let's go one step further. Let's say that when there's a hearing, oversight matters, but don't call the Fed chair a dangerous man. Point one. Point two, if you're on the board, don't make donations to someone running to be the president of the United States. I'm thinking of then-Governor Lael Brainerd making a donation to the Hillary Clinton campaign before then going on to becoming vice chair and then going to work for President Biden. Number three, if you've worked on both the Biden campaign and the Obama campaign, maybe don't think about going to the Chicago Fed. Austin Goolsbee, let's be consistent about this and also go one step further. Let's make sure there's a really fine line, really thick, bright red line between serving for the central bank and serving for a political party in Washington, D.C., because that does not help in any way, shape or form.
No, it doesn't help the markets, which, to the Treasury Secretary's point, they want to see monetary policy in this jewel box. These were his words. But the point you're bringing up, Jonathan, is that, yes, of course, the past week, it's all been about Republicans don't want independence of the Fed. The president of the United States doesn't want independence of the Fed. But we have seen Democrats jawbone this Fed as well. Sometimes it's not as loud coming from the President of the United States, but it certainly has been from the likes of Elizabeth Warren and others in Congress.
Who's written letters to the chairman asking for lower interest rates. Look, I'm not drawing equivalence here. I'm just saying we need to be consistent about the matter. And if you believe in central bank independence, let's go even further with it. Something to think about anyway. Let's turn to the latest on trade. President Trump slapping India with a 50% tariff, upending a decades-long push from Washington to forge closer ties. The tariff set to impact industries like textiles and jewelry, while key exports like electronics and pharmaceuticals are exempt. Some good news for the Apple CEO.
The fine print here is so important. 50% sounds massive, but then what do you really care about coming from India, really? It's going to be those iPhones in everyone's pockets, especially given the fact that Tim Cook has talked about the fact that all these U.S.-bound iPhones, he really wants to see them by 2026, all coming from India. Well, guess what? They get an exemption. That's key.
That's the latest on trade. I want to turn to the latest on this. What a story that's played out in the last week. Cracker Barrel scrapping its new logo after it sparked backlash from social media to the White House. The restaurant bringing back its old logo after critics said the simplified design stripped the chain of its history.
So they're back with the old timer. The president has got involved in this. The White House is now actually taking basically a full victory lap, that they're the ones that were able to bring back what was old. I think this is capitalism at its finest. You hear from the company. They said they haven't been able to get Gen Z excited about younger generation coming into Cracker Barrel. I don't think you've been to one. I have. It definitely feels like an old-timer kind of place. So they went with more of a modern, flat logo. Then what happened? They got all this pushback of people saying, we want the full Americana motif of the Cracker Barrel. And guess what? They realized this is what the people want. So they went back to the old version. I just wonder, Jonathan, if all this is a ploy. Would you and I be sitting here at 6:35 in the morning talking about Cracker Barrel if they didn't have this entire controversy with their logo?
I'm sure investors are hoping you're right. Unfortunately, you're probably wrong, and that's the problem. Get rid of the marketing team. For a long, long time, we had a very assertive, progressive consumer, which CEOs and C-suites and strategies had to cater to. Now, for the last few years, you've had a more assertive, conservative consumer. You should be taking account of that. You should know, you should be testing this. You should know there's going to be some backlash once you move away from heritage at a time where a lot of this country is longing for heritage, history and Americana. You should know that half the country wants that. It's a tricky moment for CEOs. I totally agree with that. But for goodness sake, hire a new marketing team, because every logo on the planet looks exactly the same, given every rebrand I've seen over the past decade or so.
I totally agree with you. Everything looks the same, which is actually why I think people are starting to push back. And for this one, they felt like, the straw on the camel's back. What is interesting, though, is maybe what Cracker Barrel is showing, a blueprint to people, is that actually listen to your consumers. When they do push back, be quick, apologize, say we're going back to the old timer. Taylor Budowich, one of the president's key deputies, said he had a call last night with the company. I am just waiting for the president to make a field trip to a Cracker Barrel now. And for the company, this is actually helping them.
Cracker Barrel up by about 6 to 7% in the pre-market. Let's turn back to tech. Investors looking ahead to Nvidia's earnings after the closing bell. Angelo Zino of CFRA raising his price target to 206 and maintaining a buy rating on the stock, saying we are growing more confident about sustained demand for Nvidia's data center business. Angelo joins us now for more. Angelo, welcome back to the program, sir. What's your big focus later on this afternoon?
Yeah, so thanks for having me. And, I think for us, listen, the demand landscape remains extremely strong for Blackwell specifically. We continue to see that ramp up here. Second half of the year, you're going to have the Ultra launch as well. Cloud service providers, continue to increase their CapEx numbers. So as far as the numbers are concerned, looking at about $46 billion here for the quarter, growth rate year over year north of 50%. It's important to note that there's going to be a reacceleration on the sequential growth side of things. You're talking about closer to mid-teens growth for the October quarter. It's a high bar, but nonetheless, the backlogs that we're seeing from a lot of these OEMs out there, we think warrant the fact that you're going to see that higher revenue trajectory from Blackwell going into the second half. As far as what we're looking at, or we think could potentially move the needle for the stock here, just given that the run-up it's already had, I think there are two items. One, take a look at the gross margins. The company guided or implied that we're going to see sequential improvement in gross margins here as the year progresses. We're looking at 72% this quarter, 73.5% next quarter, and continue to see further margin expansion. So we need to see that execution on that side of things remain intact. And then China, I think, is going to really be the big story and what Jensen has to say about the demand trajectory for China for the October quarter and going into 2026. And I think those are really going to be the two items which could potentially move the stock, significantly one way or the other.
Angelo, let's pick up on the China piece of the story. You've talked in the past about how the company had moved to de-risk the Chinese story. Can you tell me how relevant that is now to the stock?
Yeah, listen, you look at the July quarter, right? Essentially zero revenue in terms of for China within their data center business. So that's important, really, because there's only upside as far as the revenue trajectory for China is concerned. But that being said, you are seeing a lot of analysts out there starting to throw some numbers in for China, and there's a wide range out there. Our view for the October quarter, it's probably going to be on the smaller side of things, maybe 1 to 3 billion or so. But again, more importantly, is going to be the opportunity and upside potential going into 2026. Our view has been, the H20 at this point in time is probably so old that, China can probably do without it, and they're probably looking to push, a Blackwell chip into that market, something that Jensen is really trying to push with the administration. So commentary on that side of things, maybe where he stands in terms of trying to get a Blackwell chip going into China, I think is going to be really important to see that momentum and revenue trajectory really start to ramp up in that region.
Even if China was able to get the Blackwell chip, does it matter? The FT this morning is saying that China chip makers look to triple output of AI chips next year. How far advanced is the U.S. compared to China?
I think when you think about how advanced, I mean, they're multiple generations ahead. We think when you look at NVIDIA's most advanced chip. But that said, I think it has a lot more to do with just the actual chip itself and more about the ecosystem and the ties that NVIDIA has with the developers out in China. So I think that's a critical aspect of all this. And, again, I think it's one of those, if you listen to the Alibaba's, Baidu's of the world, and Alibaba reports later this week, I think you'll hear that, it's important for them to have access to NVIDIA's ecosystem, their software and capabilities. So Huawei is definitely a formidable threat out there. I think the demand landscape actually in China is going to continue to be very robust as well. So there's no surprise that you're going to see significant demand, not only from the domestic industry, but we think also from NVIDIA, if they can kind of get, again, their more advanced chips relative to the H20 at least.
Do you basically expect, if they're able to get more of those advanced chips over to China, that the U.S. government is going to demand a cut?
I mean, at this point in time, probably, we do expect the U.S. government to continue to ask for the cut that, they previously alluded to, which is that 15%, cut. So I wouldn't expect any change from that, at least at this point in time.
Angelo, can we just finish on something that I think is going to become a bigger story 12 months out? Might not be now, perhaps you haven't developed firm thoughts on the matter, but the price of electricity. Angelo, this is going to become potentially a massive political issue, and the pushback you could see from the electorate against the build-out of data centres and the thirst for electricity and the increase of price in energy that we could see in this country and elsewhere could be absolutely massive. Angelo, as a risk factor, is that something you've begun to think about, and how are those thoughts developing if they are?
I mean, are we talking about kind of the price of electricity that's going to get pushed to the consumer? Or are we talking about kind of the price of electricity that, these hyperscalers are going to have to pay for? Because, the way I look at this is, there are contracts being put into place at this point in time by the hyperscalers, and they're willing to pay, in excess of, whatever the existing price is in order to kind of make sure that there is, enough capacity out there to meet the growing needs for AI. But no, to your point, absolutely, I think there's a huge risk out there in terms of the availability of supply to meet the needs of AI if kind of the explosion is to the extent that some of these companies are alluding to. It's probably going to be the biggest bottleneck, we think, for the adoption of AI here as we kind of look out over the next 3 to 5 years. So I think it's one of these fluid stories out there. But, typically what I've learned is, when you have issues like this over time, the tech industry is able to find solutions to it. But yeah, it is definitely an issue out there that we're going to have to keep an eye on. And it's probably going to be problematic, as we kind of look out, maybe a little bit more further than 12 months out from now. Sure. But yeah, over the next 3 to 5 years, definitely an issue.
We'll appreciate you weighing in regardless. Thanks, Angelo. Appreciate it. Thank you, sir. Angelo Zino there of CFRA, because the consumer does not have a Mark Zuckerberg-sized balance sheet, that's for sure.
I'm glad you brought this up, because did you see yesterday at the cabinet meeting, the president said he got this photo they held up from Mark Zuckerberg, and what it was an AI data center they're building in Louisiana, and it's the size of Manhattan, basically. So you saw how the data center was just basically superimposed on Manhattan. And Trump talked about this, the energy demand that is going to be needed for this. And already this is a conversation in Washington, because congressmen and women are really concerned about individuals and small businesses having to pay higher electricity prices.
NVIDIA in the pre-market higher by about 0.75%. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. Aside from the Lisa Cook drama, we're learning President Trump is stepping up his efforts to exert more control over the central bank. Sources telling us here at Bloomberg, the Trump administration is reviewing options for exerting more influence over the Fed's 12 regional banks that would potentially extend its reach beyond personnel appointments in Washington. Meanwhile, French Prime Minister Francois Bayrou is under pressure as opposition parties unite against him. The far-right National Rally, leftist France Unbowed, and the Socialist Party all plan to vote against Bayrou in next month's confidence vote, potentially forcing his government to resign. And the Justice Department is widening its probe of United Health. Sources telling us here at Bloomberg, the DOJ's criminal division is looking into the company's prescription management services, as well as how it reimburses its own doctors. The previously unreported areas of the probe show the scrutiny goes beyond an inquiry into possible Medicare fraud. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, slapping tariffs on India.
I don't want to make a trade deal. No, we want to make trade deal. You're going to put tariffs on you that was so high, I don't give a damn. Your head's going to spin.
That conversation up next with the former Trump trade official, Kate Kalutkiewicz, live from New York City. You're watching Bloomberg. Bouncing back in yesterday's session, closing within 0.1% of all-time highs on the S&P 500. Futures this morning just about positive. Likewise on the Nasdaq 100. Under surveillance this morning, slapping tariffs on India.
I said, I don't want to make a trade deal. No, we want to make trade deal. I said, no, I don't want to make a trade deal with you. I said, call me back tomorrow, but we're not going to do any deals with you, or we're going to put tariffs on you that are so high. You're going to put tariffs on you that was so high, I don't give a damn. Your head's going to spin.
Here's the latest this morning. Trade in focus with the White House hitting India with a 50% tariff as the de minimis exemption is set to end on Friday. The former Trump White House trade official Kate Kalutkiewicz writing the following. The expanded tariffs further weaken the prospects for a near-term US-India trade deal, with bilateral talks stalled. Kate joins us now for more. Kate, welcome back to the programme. I think we have to start from the very top, blurring the lines between economics and national security objectives. Can you just build on that and why India is so important right now?
Yeah, the situation with India is at a place I think none of us predicted early in the president's term. You know, they had risen out of the gate really as one of the first countries with which we expected a trade deal. But these national security issues, particularly the ongoing situation with Russia and Ukraine, have really elevated them as a problem in the president's mind. And now we see tariffs reaching the levels of China, almost the highest of any country at present.
Okay, as you know, China still buys Russian energy. The Europeans still buy Russian gas. Does consistency matter here?
Well, apparently not. The president has made clear, of course, that he'll go after some of these other nations with this new executive order that targets buyers of Russian oil. But it's very clear only one country has received the additional penalties, and that's India. So hard to say that there's consistency here.
So where do the talks stand now? We know that they're basically on hold. How quickly could these two trading partners coalesce and get to an agreement?
Well, as we've seen with other previously stuck agreements, I mean, I think anything can happen if you get the two leaders together. What we've seen so far, however, is that, you know, India's prime minister, because he has his own domestic political challenges, of course, is somewhat reluctant to get on the phone with President Trump. As you all know, that can be quite uncertain as to what the president can ask when he gets on the phone with you. But I think it could get unstuck if the two men get together and find a pathway forward. That's what we've seen happen with President Trump, and I think it could happen here with India.
Is it going to potentially hurt India's chances, given the fact that Prime Minister Modi is set to have a meeting and meet Xi Jinping in the next couple of days?
Well, I think that Prime Minister Modi is trying to flex a little bit here and show that he has other options. I'm not sure it will impact President Trump's view of this. I think this still has to be an issue resolved between the United States and India, and it doesn't matter if the Indians bring the Chinese alongside. It is hard to ignore, however, that the highest tariff rates at present really are on countries aligned with China, and that's China, India, and Brazil, a group of nations the president has repeatedly targeted.
When it comes to the exemptions, though, this is really key. The likes of Apple, which put a lot of time and effort into moving their supply chain out of China into India. Do you think that exemption stays?
Well, that exemption is not really related to India so much as it is to the president's impending action on semiconductors and their derivatives, like the products Apple makes. So that exception is really in place only until the president makes that move on semiconductors, which, the White House has said is imminent. But you raise a very important point, which is in President Trump's first administration, a lot of companies moved from China and they moved to India. So, we could see some very dramatic consequences for those that have done their manufacturing there.
Annmarie, just to build on some of that, Mexico, Canada. Kate, next year, how crucial are those negotiations going to be?
They're really important. The U.S.-Mexico-Canada agreement, of course, is coming up under review. This was an agreement renegotiated by the first Trump administration. It's an agreement he's called the greatest trade deal ever negotiated. But the truth is the North American supply chain for American manufacturers is critical. It is crucial in this global competition with China, with India. And I think it will be very important to see that reshored, essentially, and restabilized.
Well, when it comes to the goods that are going between these borders, 90% are USMCA compliant. So they are also getting this exemption when it comes to the tariff rates. What does the Trump administration want to see build upon their USMCA that they themselves struck when it comes to renegotiating that exact trade deal?
Well, I think what we've seen in a number of the trade frameworks is what we're going to see in the USMCA negotiations, and that's to get rid of what we consider transshipped goods. And again, this is to ensure that Chinese inputs, Chinese goods are not somehow making their way into the United States through our North American partners. So when the USMCA was renegotiated, we did see tightened rules to ensure that all cars that benefit from USMCA are almost entirely North American content, about 75%. I think the president will push Mexico and Canada for similar commitments on a range of goods to ensure that anything benefiting from this duty-free treatment is actually a product of North America.
Okay, we're still trying to figure out if some of these tariffs actually stand up to legal scrutiny. And at the cabinet meeting yesterday, the Treasury Secretary talked about customs revenue of north of $500 billion a year. Are these tariffs and the revenue they're generating now too big to strike down?
Well, it's a great question. I think we are nearing that. And certainly the president's rhetoric, the president of his cabinet, really justifying the value of these tariffs and what they're doing for the deficit in the United States indicate that by and large, they are here to stay. We have action after action piling up, which threaten to raise the tariff level. I think it's going to be very challenging in a wholesale fashion to see these tariffs coming down anytime soon.
Kate, appreciate your time. As always, the former Trump trade official, Kate Kalutkiewicz, there on the situation with global trade and what's going to happen with the legal issues in the days to come.
Right. What did Henrietta Trey say? She is waiting for the courts to, what she thinks, strike down IEEPA, but then they're going to have other avenues to keep tariff rates. You mentioned the Treasury Secretary yesterday. Not only did he talk about the tariffs coming in, he, even though he doesn't like the CBO, he says once in a while they have good analysis. The CBO recently said that basically the tariff policies could reduce the deficit by $4 trillion over the next decade. And the Treasury Secretary said yesterday he actually thinks that number is going to go up.
Are they going to have consequences? That will for the bond market. The 10-year this morning, 4.27. Up next on the programme, we'll catch up with Drew Matus of MetLife, Marc Short, the former Chief of Staff to former VP Mike Pence, Geoffrey Gertz of the Center for a New American Security, and Krishna Memani of Lafayette College. Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance, just around the corner.
The Federal Reserve is in an incredibly difficult position here.
This is a real assault on the Federal Reserve's independence.
The Fed is under a lot of pressure in terms of the future policy path.
I expect to see a little bit more done to control the long end of the yield curve this time.
What you're seeing in the long end is certainly somewhat worrisome.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500, adding just a little bit of weight to yesterday's rally, very close to all-time highs. Futures this morning, very much unchanged on the S&P and the Nasdaq 100. In the bond market, 2-year, 10-year, 30-year, things just settling down after all the drama surrounding the Federal Reserve in the past 24 hours. Bond yields up by a mere basis point at the long end of the curve, down a couple at the front end. The 2-year, 365.97, 30s, 492.75. Your week ahead is shaping up as follows. Later in the week, the main data point, core PCE. Before we get there, though, after the closing bout, the data point maybe of the week beyond PCE, Nvidia earnings. Tech giant Nvidia reporting after the closing bout.
Highly anticipated to have this earnings report after the bell today when it comes to Nvidia. Of course, on one side, we have seen already what their biggest customers are saying. They're spending big. We're talking eye-watering numbers when it comes to AI, and that's 40% of their revenue, Jonathan. But then on the downside, people really want to know and get a clear picture of what is going on with Nvidia and their sales to China. There's been this almost off and on again sales momentum given the policy in Washington, D.C., and no one really has a clear understanding of actually how much they are still selling into that market.
You can't sell them, you can sell them, but you need to give us a cut of the revenue. That's the message from the White House recently. The Chinese, we want them, now we don't want them. Do the Chinese even want them in the country right now? That's part of the debate in a way that maybe it wasn't in the last few months.
Which is why there was this report that what you saw from Nvidia is going back to their suppliers for components for the H20 chip and saying stop making them right now. And that was just days after we exclusively reported that firms in Beijing, the CCP, basically telling companies to shrug off these chips. But Angelo made a really good point earlier, and that's what's going to happen with the Blackwell. Jensen Huang has done a very good job as the CEO of a company pushing this administration to seeing his worldview. Will they do so with these higher advanced semiconductors as well?
That stock at the pre-market higher by 0.6%. This rally is not all about big tech. It's about other parts of the market too. The S&P 500 within 0.1% of all-time highs. Banks, the KBW Bank Index at a record. Home builders up so far this month by 15%. Delta, United Airlines up by double digits for the month of August. This economy is not looking great at the moment, but this market is pricing in a rebound.
Market's pricing in the rebound. They're also pricing in a rate cut when it comes to September. And that is why I think the PCE report is going to be so interesting. Well, actually, I thought it was going to be so interesting, Jonathan, before, as you've continuously mentioned, Jay Powell basically told us all to look through any hot CPI prints because there's going to be an on and off effect when it comes to the tariffs and how they're going to impact inflation. Everything is going to come down to this jobs market report. But right now, the market's pricing in a Fed rate cut in September.
Payrolls a week Friday. Coming up this hour, we'll catch up with Drew Matus of MetLife ahead of earnings from Nvidia. We'll speak to Marc Short, the former chief of staff to the former VP Mike Pence, on the growing turmoil at the Federal Reserve, and Geoffrey Gertz of the Center for a New American Security as the White House looks to take stakes in more U.S. companies. We begin this hour with stocks near all-time highs ahead of earnings from Nvidia. Drew Matus of MetLife writing, there is too much short-term faith in AI. The real impact of AI will take place over the next decade, not over the next year. Drew joins us now for more. Drew, welcome, sir. Just build on some of that if you can. Do you think this market is super offside then?
Well, no, I think the investment for AI has to take place now. But when I think about productivity and I think about cost savings, is that going to come from existing companies or is that going to come from companies that are built within an AI ecosystem? Because they're going to look very different than the companies we have today. And I think those are the companies that are really going to drive the productivity experience, for markets. And then on the kind of social side, it's really going to be a big boost to educational quality. And you can use AI to basically create individualized tutors for students. Those students will benefit from that. And what we're going to end up with is a surge in labor quality because educational quality is going to be going higher in the United States.
Drew, that's the upside. Let's discuss the constraints. Are we already starting to see them materialize in energy prices, in electricity? And how do you think that's going to ramp up in the years to come?
Well, I think that there's, a lot of interesting things going on in energy, including kind of, a movement towards kind of more predictable supplies. And I think that, what we're seeing is actually kind of a confluence of factors, some of which are political and some of which are being driven by AI. It's everything has consequences, right? I mean, you switched from, horses to automobiles, and that created a whole bunch of changes in jobs. It created changes in energy supplies. There were all kinds of people who got put out of work and all kinds of people who entered jobs that didn't exist a few years before. And I think AI is clearly going to be something like that, where people are actually forced to kind of reevaluate. And there's of course going to be losses within that. And managing those losses is really going to be the challenge for the government and for companies as we move forward.
Well, to John's point on electricity, I mean, how much higher do you think energy demand as well as price might actually go?
Well, I mean, it's an open question because I think, anyone who lives in northern New Jersey sees that, the brownouts, there's, kind of issues with electricity on a day-to-day basis that, if you think back 10 years ago, just wasn't happening, right? And so I don't know exactly how that gets resolved, but I do know it has to get resolved, and it's worth the focus of the government to make sure that there are sustainable supplies of energy. And I mean sustainable in the way that maybe predictable is a better way, right? You shouldn't be having brownouts in the United States of America. It just shouldn't happen.
When you talk about the short-term faith in AI, and actually really this is a long-term project, what companies do you think are going to be the ones that are doing the work now that's going to pay off in the next decade?
Well, as I said, I'm more focused on kind of what kind of companies come after the companies that we currently have, right? And what does the future of kind of corporate America look like? If you were to build a company from scratch today, how would you build it differently than a company that's been around for a few decades? And I think the answer is you'd probably build it very differently because you'd have a very different structure with regard to the number of employees. You'd have a very different structure with regard to how those employees interact with each other. And the real challenge for kind of companies today is going to be how do we adapt to stay in front of that curve?
Drew, I want to build on the rest of the equity market. It's not all about tech. We've seen a rebound in small caps, a bounce in the banks, the home builders, seeing the same thing with the airlines as well so far this month, Drew. Do you think the economic data in the months to come is going to back that up?
I don't. I actually think that, I think the labor market is in the process of weakening and will continue to weaken. I think a few Fed rate cuts because the economy is weakening is not usually a good thing, right? What you want the Fed to be able to cut for is because productivity is accelerating and there's a limited danger of inflation. And while we're not really so worried about the inflation story, even if we expect it to be a little high, the growth story just isn't that great. Who actually are going to be buying these things? Who's going to be doing these things? Are people going to feel confident going out and spending? And I think the answer is increasingly that people are trying to find ways to cut back in order to basically pay for higher energy costs, for example.
Drew, to build on that, and I think this is so important, we often say this, not all rate cuts are created equally. Some are because of a softer labour market, others because inflation is contained, and we certainly don't have the latter at the moment, so let's sit on the former. Drew, if you believe that, what do you think the correlation is going to look like between stocks and bonds over the next quarter?
I mean, I actually think that the long end of the curve is kind of stuck where it is, and any kind of cuts are going to come with a steepening. So it's going to be a bull steepening, but it's going to be a steepening. But I do think the long end is pretty much locked where it is today. Maybe you get down to 4, but by and large, I think 10-year yields are going to be where they are right now, plus or minus 25 basis points.
Drew, are you surprised that we haven't seen a massive move in terms of markets overall when it comes to the drama surrounding the Federal Reserve and this administration?
I'm not, because I think people are kind of wanting to see this play out. I also think, look, for the Fed to be independent, they have to be above reproach. And now we don't know what happened, but if the Treasury Secretary was exactly correct, right? It's an agreement between the Fed and the American people to basically say, look, we trust you to manage your business and to do it in a way that's appropriate. If that's not being held up to, then of course there's going to be a re-examination of that. And I think, all the weeping and wailing and gnashing of teeth about this being an attack on the Federal Reserve, I don't see it as being an attack on the Federal Reserve. I see it as being, if you separate it from the person making the comments, would you still have the same visceral response? And I think the answer would be no. You'd be thinking more about the allegation rather than about who made the allegation and what it might mean going forward. The main key point is if you want the Federal Reserve to be credible, the people on the Federal Reserve have to be above reproach. And if that's not happening, then Federal Reserve independence doesn't matter anyway.
So, Drew, we've had this dance between politics in Washington and the Federal Reserve for a long, long time. It's not new. We've seen people go from the Federal Reserve to the White House, from the White House to the Federal Reserve. Do we have to be consistent about that? I think we should be. Should we start to establish rules about the ability to switch from one to the other down in Washington?
I think there should be a lot more rules about kind of once you're on there. You know, I think we've reached a period where people think, you know, they don't really think about what they've done. I think if you think about the Federal Reserve, you can think about it like, you know, hey, you know what, I'm going into, you know, this is going to come across wrong, but like, you know, I'm entering a new regime. I'm entering, you know, the priesthood, for example, of finance. And, you know, that means that I have to be A, above reproach, B, I have to kind of sever old ties, and C, I have to really think about when I'm moving into and out of that organization, you know, am I actually still, I am still representing that organization. I'm representing that organization for the rest of my life, right? So there has to be this mindset in people. And I think as a society, actually, we've moved away from a mindset of kind of personal responsibility and credibility. And it's hurting us as a country. And I think, you know, what we're seeing it reflected in now is the political sphere.
Drew, appreciate your time. Drew Matus of MetLife. Some thoughtful stuff on the Federal Reserve. Slightly contrarian based on what we've heard on this program over the last 24 hours.
Definitely contrarian, especially given the fact of the last 24 hours I spoke to the former Fed Vice Chair, Lael Brainerd, who really feels like this attack on Governor Cook and the question about her mortgage fraud is an attack on the entire institution. But actually, I think the market is lining up to where he is, because the reaction has basically been, we need to just wait and see how the courts decide. And when it comes to the courts, I just go back to what the Supreme Court said in May, which is that the Federal Reserve is a quasi-private entity, basically inoculating it, Jonathan, from any sort of political attacks that can come down upon it or potentially political maneuvers.
This is going to take months and months to figure out. In the meantime, the market's doing okay. Equity futures just about unchanged on the S&P 500 with an update on stories elsewhere. With your Bloomberg Brief, here's Yahara with more. Hey, Yahara.
Hi, John. As you all were discussing, President Donald Trump said he's prepared for a legal fight with Fed Governor Lisa Cook after he attempted to fire her while Cook's lawyer vowed to file a lawsuit over Trump's move. The Fed said it would abide by any court verdict and deferred any decision on Cook's current working status. Meanwhile, Ukraine's president says China's Xi Jinping sent him Independence Day greetings, the first known contact in more than 2 years. President Volodymyr Zelensky shared the note on social media, saying he appreciated Xi's outreach and highlighted mutual interests in advancing bilateral ties. The message comes just days before Vladimir Putin travels to Beijing for a major summit. And Nikon shares surged in Tokyo after Ray-Ban maker Eswar Luxottica said it's considering increasing its stake in the Japanese optical equipment manufacturer. Sources telling us here at Bloomberg the Franco-Italian company is considering boosting its stake to 20%. That is more than double its current holdings. Deliberations are ongoing, and there is no guaranteed transaction. That's your Bloomberg Brief. John?
Yahara, appreciate it. More from Yahara in about 30 minutes' time. Up next on the program, gearing up for a legal battle.
Fed Governor Lisa Cook, her lawyer has said that they're going to be filing a lawsuit challenging this legal action. What is your response? Are you prepared for a legal fight?
She seems to have had an infraction, and she can't have an infraction.
Up next on the program, Marc Shaw, the former chief of staff to the former Vice President Mike Pence, joins us in just a moment. From New York City this morning, good morning. Nvidia in focus after the close later on this afternoon. That stock in the pre-market higher by 0.7% following 3 days of gains coming into Wednesday. This from Dan Ives of Wedbush. The street continues to underestimate the demand curve for the AI revolution, being led by, guess who? By Nvidia. This market is doing okay. It's very close to all-time highs, drowning out the drama down in Washington, D.C., shutting out the noise. Futures positive by around about 0.1% on the S&P so far this morning. Under surveillance this morning, gearing up for a legal battle.
Fed Governor Lisa Cook, her lawyer has said that they're going to be filing a lawsuit challenging this legal action. What is your response? Are you prepared for a legal fight?
She seems to have had an infraction, and she can't have an infraction, especially that infraction, because she's in charge of, if you think about it, mortgages, and we need people that are 100% above board, and it doesn't seem like she was.
So here's the latest. Sources telling us here at Bloomberg that the Trump administration is looking to exert more influence over the Federal Reserve's regional bank presidents. Bloomberg's Tyler Kendall has more. Hey, Tyler.
Yeah, hey, John. Well, a person familiar tells us that the White House is saying that this wouldn't necessarily be about trying to make the central bank more dovish, but rather about heightening scrutiny over the vetting process of regional bank presidents, considering that they don't go through a Senate confirmation. And it's putting heightened attention on what's a once in every 5-year exercise, which just happens to be happening this February, when the Fed Board of Governors will look to authorize the current roster of Federal Reserve regional bank presidents. And the concern here being that if the White House were to secure a majority on the Fed Board of Governors, 4 out of the 7 seats being Trump appointees, then officials could potentially use this as another tool in their pressure campaign by putting heightened scrutiny on this reappointment process. Now, whether or not this actually happens remains to be seen. But one thing that's becoming increasingly clear in the reporting is that this White House doesn't appear to be showing any intentions that it's going to let up its pressure campaign on the central bank, with, as you've been covering, the president saying that he's prepared for this expected legal fight over his decision to oust Fed Governor Lisa Cook, telling Annmarie yesterday in the cabinet room that he's prepared to abide by any decision. Because, of course, the next steps we're waiting for is how this legal fight is going to progress and when Lisa Cook could potentially file for an injunction, which would immediately reinstate her into the position as a Fed governor, as this essentially works its way through the legal system. John, of course, President Trump is elevating allegations of mortgage occupancy fraud against Cook, but important to note that at this point, they are only allegations and no formal charges have been brought.
Tyler Kendall with the latest in Washington. Tyler, thank you. Here in New York City, Marc Short, the former chief of staff to the former Vice President Mike Pence, joins us now for more. Marc, good morning.
Good morning. Thanks for having me.
Thank you for being here. A much more interventionist White House over the past week and maybe the last number of months as well.
Yeah.
Can you just weigh in? How are you framing things at the moment?
Well, on this particular topic, I actually think there is probably broader support among a lot of small government people who say, you know what, the notion of a Fed truly being independent was a nice notion when before it had $7 trillion of assets on its books. And so you have a lot of unelected people with 14-year terms that have enormous influence over the economy. Having said that, I think there's probably a desire also that if there was actually effort to change it, it would be more above board than coming up with sort of these fraudulent charges against the board governor, because there's probably plenty of political appointees in the administration who have multiple mortgages too and have said they're both their primary residents. So I'm sure there's a double standard here, and I wish there was a more intellectual appeal about the Fed's role as opposed to coming with bogus charges.
I just want to pick up on the language, a difference between charges of fraud and fraudulent charges. Which one do you think it is?
I think these are bogus charges. I mean,
what makes you believe that?
Well, I don't know how many homes she has, or if she listed both as prime residents, but is that really a reason you're going to remove somebody as a board governor? And I believe there's probably plenty of people in the administration who have done the same on their mortgage files.
Well, lots of reporting over this summer about Ken Paxton, who's the Attorney General of Texas, who's running to be the senator.
Right. Great point.
And do you think this litmus test now for the president? He's going to decide whether or not he's going to back Ken Paxton because he has 3 residences listed as a primary mortgage home?
Annmarie, he's very flexible on these things. I think this is more about his effort to exert control over the Fed, because I think they're concerned that their trade agenda is causing great weakness in the labor market, and they want rates lower. And to be fair, this is what the president has always wanted, is lower rates. Even when he had the option to appoint Jerome Powell in the first administration, there were 3 options between Kevin Warsh, John Taylor, and Jerome Powell. And the president asked, who's going to make rates lower? And that's one of the ironies, is that he chose the person who Steve Mnuchin told him was going to keep rates lower, but obviously he wants them even lower than they are now.
How difficult is next week going to be if the Senate Banking Committee begins their hearing of Steve Myron? When you look at some of the Republicans on that committee, are we going to see pushback not just from the likes of Elizabeth Warren, but also like Tom Tillis?
We haven't seen it yet, Annmarie, so I'm not so confident there's going to be significant pushback on his appointment. I think this is about an effort to exert control and have a majority so he can lower rates faster. But again, I think it's reflective of a concern about where the labor market's going.
I remember Stephen Moore nominated for a seat on the Federal Reserve.
Yeah.
The Senate was Republican at the time, and he didn't make it, and there was pushback. What's the difference between that first term for the president and this second term?
Yeah, great question, because I think this is much broader than the Federal Reserve. I think it's about all of his nominations. I think that, you go to his cabinet, and I think it'd be hard to envision that RFK would have gotten confirmed in a previous Republican-controlled Senate. I think this is basically a reflection that Republicans are very worried about the president primarying him. He has shown his ability to engage in primaries and exert that control, and there's just an enormous fear factor, and he's using that with great leverage amongst Senate Republicans.
Has the party changed?
The party's absolutely changed, John. I mean, I think the party has certainly become far more populist. I think, when you see basically the federal government looking to seize means of production, and the biggest cheerleaders are Elizabeth Warren and Bernie Sanders, and there's not a Republican speaking out about the government taking over 10% of Intel, on the heels of saying, in selling, we have export controls, we don't want to sell these chips to China. Oh, but if you allow us to take 15% of the profits of NVIDIA, it's okay. And on the heels of saying we're going to take golden shares of Nippon Steel, U.S. Steel, it's like this is clearly moving in a direction where the populism and the progressive merge, and there's been total silence among Senate Republicans.
And Senate Republicans, with their silence, you say potentially, though, they're interested in revamping the Federal Reserve because they're in favor of small government. Nothing you just listed in terms of taking shares of companies is small government.
Annmarie, that's, I think, one of the shocking parts is that I do believe that the first Trump administration was predominantly small government. It was deregulatory. It reduced taxes. And I feel like the second administration is exerting its influence in all sectors of the economy and looking to exert its muscle. And I think it's a very different agenda.
To be more constructive on what they're doing in terms of, say, Intel, there's been a lot of criticism that they're mirroring what China does, or this is state capitalism like Europeans did in the 1960s. What do you actually think Trump is thinking? Is this about building a sovereign wealth fund? What is actually the strategy?
I think that he kind of rejected the sovereign wealth fund the other day, but I do think it's concerning that, that the trajectory there is basically Saudi Arabia, China, Iran, Russia. Those are the ones with sovereign wealth funds. I certainly hope that's not where we're going. I do think it's more, in his mind, simply about leverage and where he can have leverage. But again, the base of it was 2 weeks before he more or less insinuated the Intel CEO was a Chinese spy. And then basically basically saying, okay, well, we're not so worried about the national security anymore as long as we can have 10%. It's like, what's the justification? And I feel like when you do this, you crowd out private investors. I don't think this would be good for either side. I think you're going to see Intel stock probably decline, because what private investor wants to engage if they feel like the federal government can just come in and take 10% or more?
The sovereign wealth funds, the CHIPS Act. That's the investment vehicle. I didn't see that coming, but that's where this is going, apparently.
Well, yeah, potentially. I mean, and it's also not just the examples Marc Short brought up. You also had the DOD recently take a stake in a company as well. And Howard Lutnick is basically saying that this might be potentially direction of travel for other defense companies.
Marc, this was great. It's good to see you.
Thanks for having me. It's good to see you guys.
The traditional Republican view of what's playing out down in Washington, D.C.
It isn't a traditional Republican view when it comes to what is going on with this White House and corporate America. They are taking a much more interventionist approach, which usually really puts the hair up on the backs of most Republicans.
A conversation will continue. Up next on the program, we'll catch up with Geoffrey Gertz of the Center for a New American Security. Plus, Danny's back with your morning movers as shares of Coles are soaring following an earnings beat. That stock is up by 17%. From New York City, you're watching Bloomberg TV. Equities just about positive on the S&P 500. Big day coming up. Earnings from NVIDIA after the closing bell. Futures positive by 0.05% on the S&P. On the Nasdaq 100, up by close to 0.1%. And after some decent outperformance on the Russell in the last 24 hours, a bit softer there. We're down by about 0.1%. With 2 hours until the opening bell, let's get you some morning movers. We can do that with some single names with Danny. Hey, Danny.
Hey, John. Some retailer earnings coming in. JM Smucker falling in the pre-market, down a 4.25% this morning. It was a miss on their earnings. Basically, all the categories looking weaker. Everything from their coffee brands to pet snacks and human snacks. You know it's bad when you're not giving your pets as many treats. The CEO there saying that it's a dynamic external environment. Of course, they're also dealing with things like tariffs on Brazil, which in particular would be hurting their coffee business. However, positive results when it came to Kohl's reporting this morning. They've been in the middle of a turnaround effort, so maybe this is giving some credence. It is a beat and a raise for them. 17.3% is a surge we're seeing. And perhaps key for one of these consumer-facing companies that is also dealing with tariffs is the fact that they were able to raise their margin outlook for the entirety of the year. Now, finally, wrapping things up with PayPal, those shares are falling this morning, down 2.4%. A German outlet reporting that there appear to be some security issues with PayPal, some sort of system failure, that system looks at fraudulent payments. So German banks have been blocking direct debit payments from PayPal over fears over what that security system failure might mean. So again, those shares down in the pre-market, John.
Danny, thank you. Thanks for the update. Appreciate it. More from Danny in the next hour. On our radar this morning, President Donald Trump hitting India with 50% tariffs as punishment for buying Russian crude. The move putting a strain on ties with the Prime Minister Narendra Modi. Key exports like electronics and pharmaceuticals are exempt.
And that's really the key here. These ideas like iPhones, which basically Tim Cook did a lot of work moving logistics from China to India. He says by 2026, he wants all the U.S.-bound iPhones to be coming from India. There was this concern, are they going to be hit with this massive high tariff? Kate Kalutkiewicz, though, was saying that this really has less to do about India and more to do about the president waiting to go forward with his semiconductor tariff rates. So potentially this story could continue in what might actually be exempt or not, depending on how they're going to view the chip sector and what tariff rate that's going to be set at.
So India, of course, has massive barriers to entry to export into the country. That's been a problem for a while. They would say we're an emerging market. We need to protect infant industries. That's becoming more and more controversial as that country grows richer and richer. The justification for this, though, I think they've got some reason to be a little bit irked with this situation. They're not the only ones buying Russian crude. Chinese are as well. Europeans are buying Russian energy, for goodness sake, still. And yes, that number has dropped away compared to what it used to be, sure. But that's still a massive, massive problem. And a question of consistency will be a question that's asked from, I imagine, trade partners.
Right. And this question has been put forward to the administration because the number one buyer of Russian energy is China. And that is the reason why Putin is able to continue funding this war on Ukraine. When you ask the administration about it, what they will say is, well, China actually has diversified and their numbers haven't really changed, maybe come down a little bit even from Russia, even though they're number one buyer. They are diversified. They're saying India was opportunistic and took advantage of the situation. Also, this is a problem, though, for Modi, because this means he's having a very tense relationship with the President of the United States. This was someone that everyone thought a trade deal could happen almost immediately. And what do we see him doing this week? He's having a meeting with Xi Jinping, and he's leading into countries part of the BRICS.
You were in the room with the cabinet just yesterday. The Commerce Secretary Howard Lutnick sparking a minor rally in defense stocks after suggesting the U.S. might take stakes in some defense contractors. Lutnick mentioned Lockheed Martin, saying it gets most of its revenue from federal contracts.
So I guess because it gets revenue from federal contracts, they think they should have a piece of the pie. I guess if you're looking at the art of the deal, though, when you see what valuations are right now, why take a bite of the apple when valuations are so high? Isn't art of the deal to really buy low and then sell high? Not going to get into how they're thinking about where valuations are. What I will say is that whether it's Intel, whether it's this golden share of Nippon Steel, there was also the Pentagon having a deal with a rare earths mineral company, MP Materials, $400 million equity stake. I think that's what they're looking at in terms of where they're going to play in the defense sector. And they're going to say, we're doing this because of national security concerns.
Look, sometimes the free hand of the market doesn't help you secure national security objectives. Building out domestic foundry capacity for semiconductors might be an example of that. OK, but I think we want to do our best to foster innovation. And I don't think anyone could sit here right now and say that private defense contractors in America haven't fostered innovation over the past few decades. They have the technology that everybody wants. So I'd be asking the question, OK, if you want to take stakes in these companies, what aren't they doing that you'd like them to do? Is this really about national security objectives or just about getting some money?
Well, I think that's a question everyone's asking. What are you basically, and we saw this in the Biden administration, national security ended up being this cloak put on everything else to make movements that were either socially inclined or politically inclined. This is being used, national security, to basically get at what you want. Many are potentially going to say. What I will say, though, Jonathan, is the government is intervening, and it's not going to stop here. And Howard Lutnick was pretty clear about that yesterday.
Speaking of intervention, the White House trying to gain more influence over the Federal Reserve's 12 regional banks and looking at how regional presidents are chosen. The Board of Governors is set to approve the current roster of Reserve Bank presidents this coming February, so the pressure on that institution is going to continue to build.
So the idea here is, and the president said yesterday, we're going to have a majority. Well, they will have a majority if they're able to put someone in Lisa Cook's seat. And right now, obviously, she's going to have this legal battle with the Oval Office. And if they're able to potentially have this majority, the thinking is those governors that were appointed by the president will vote to reshape how the presidencies work. Now, this might be a long shot, which a lot of people are thinking it potentially is, but we have reporting that this is something they're thinking about.
I take issue with some of this. We expect Governor Waller, Governor Bowman to go along with this and just start voting down regional Fed presidents. We're going to treat them as political puppets.
Well, you asked McKee this question earlier in the week, and it was the key question. And he said he finds that really hard to believe that those two individuals would go along with this.
That's the latest on the Federal Reserve. Let's turn back to tech and the main event after the closing bell later on this afternoon. Earnings from NVIDIA. Geoffrey Gertz, the former White House Director for International Economics under President Biden, writing the following. The financial performance of semiconductor companies, and especially NVIDIA, are increasingly driven by government policy. NVIDIA is squeezed between both the US and Chinese governments. It will be a struggle to satisfy both of them. Geoffrey joins us now for more. Geoffrey, welcome to the programme, sir. I just want to extend some of the thinking with you. Do you think it's going to get harder and harder to maintain a presence in both markets, both the US and in China?
Yeah, certainly. Thank you for having me. Happy to be here. I do think this is the real question NVIDIA is facing, and other companies as well. Can they actually manage to be in both these markets at the same time? We've seen the United States under successive administrations put in place more and more policies, certainly around export controls, making it more difficult to do business in China. And we see the Chinese government taking its own action, saying, don't trust U.S. chip companies. These chips may have secret backdoors in them, all these kinds of concerns on it. So I think, NVIDIA is clearly trying to chart out a path between the two of these. We see Jensen Huang kind of shuttling back and forth between Beijing and Washington. But it is a perilous path to travel, I think.
For a long time, Geoffrey, we always thought about this from one side. Would we allow our technology in America to go to China? And now I think increasingly we've got to think about the other side. Will China allow that technology to continue coming into the country? Where are we on that point now?
Yeah, exactly. So I think we've known for a long time that China always wanted to have its own indigenous capabilities. I think going back at least to the kind of 2018 moves that the first Trump administration put in place, targeting Huawei. The Chinese government, they're not stupid. They've been aware that this is a kind of key vulnerability for them. And so they've been trying to build up their own domestic tech capabilities. Certainly, once the Biden administration expanded the semiconductor export controls in 2022 and 2023, it's been kind of full steam ahead in Beijing to, increase their own capabilities. And obviously part of that is saying, well, don't buy American, buy domestic Chinese produced chips instead. Again, there's still this back and forth where, the Chinese want access to the real cutting edge, which remains for now only U.S. produced. But for everything less than that, they're going to do all that they can to procure that domestically. And that means kind of, diktats from the central government to support the domestic capabilities rather than buying NVIDIA or other U.S. chips.
Whether it's the 15% potentially going back those profits from sending those chips to China, whether it's the stake in Intel, this interventionist approach from this White House, what do you make of it? What do you actually think this government wants?
Yeah, I mean, that's the $1 million question there. And the short answer is I don't know. I think, look, at a very high level, you can think of these equity stakes in two ways. One is the government kind of just out to get money as sort of, a claim on future profits. Or second, is this really about more kind of governance and shaping the kind of broader development of these industries? Frankly, the administration hasn't really been clear. I think mostly what you've heard from Trump and Lutnick is talk about kind of, we want to get some payback for the U.S. taxpayers. But it's not clear to me that equity stakes are the best way to do that. And so I'm very curious to see, do we see the government want to play a kind of more heavy-handed role in actually shaping the development of these industries? Or are they really just trying to sort of transactionalist kind of get a few extra bucks wherever they can here?
Who do you think could be next after Intel?
I mean, that's also a great question. So, we've heard talk of kind of other companies that have received CHIPS Act money also being kind of potentially targets for the year. There is an important difference, right? So Intel, notably under the CHIPS Act, in order to receive grants on the CHIPS Act, you need to be hitting your various performance milestones. it seems quite likely that Intel was not hitting those milestones. And so this equity stake deal is a way for them to get that cash out even without hitting those milestones. I think for the chips companies that are hitting their milestones, they're going to be much more reluctant to deal any kind of equity stake. So we'll see how that all plays out. Defense contractors, I know you're just talking about, that's another key area where it seems quite possible. The kind of critical mineral space, another strategic sector where the government has already made some moves, and we could see some more moves, I think.
This decade, as you know, Geoffrey, you've been there. The White House, under Biden, under Trump, has really re-engaged with industrial policy. What would you say is the biggest difference between what you worked for and what you're seeing play out now?
Yeah, so certainly we've seen this longer-term shift towards industrial policy, which again I think is merited. I think it makes sense for the government to be getting involved to support some of these strategic sectors. But I think what we've seen previously is government try and set kind of broad rules of the road, rules of the game. Say here's the kind of broad policy package of subsidies, wherever it may be, that will be available to any company that meets the various requirements to qualify for it. And so sort of, set the rules of the game and then let the private sector kind of go out and do its thing. What we've seen, certainly in the last few months from the Trump administration is this much more sort of transactional, ad hoc, one-off get involved with individual companies. And so what we really see is that, traditionally where you'd have the government sort of set the rules of the game, the Trump administration is both setting the rules of the game, but then also sort of playing in that game itself and kind of going out and negotiating its own deals. And I think that's creating lots of, frankly, chaos, kind of lots of uncertainty for where the market is going, both for the companies that the government is taking a stake in, but also, quite frankly, for all the for all the companies who are sort of customers or potential suppliers to those companies. There's just tons of uncertainty and tons of politicization around this.
Geoffrey, can I just finish by saying this, and I hope you take this in the spirit in which it's intended. One of the greatest mistakes of the previous administration is that they didn't allow people like you, Dalip Singh, Mike Pyle, to engage with the public and talk about what you were actually doing. Can you share some of that with us? What was that about? Why were you all hidden away and weren't allowed to talk to us?
So I don't have any kind of direct answer to that. Look, I think many administrations struggle with sort of getting the right narrative out there. I think, this administration or the Biden administration did that as well. So I think there, is some recognition of the need to get out and tell a positive story here. I think, we are seeing from the current administration that there's lots of lack of clarity and lack of message discipline, one might say, coming out as well. So it's a problem that many administrations face. But I agree that, it's important that the public understands what is the government really trying to achieve in any of these industrial policy stakes, both to sort of just bring the public along for kind of general accountability, but also to provide kind of forward guidance for industry about where we want to go.
Enjoy the chat. Thanks for catching up with us. Come on again soon. I'd appreciate it. Geoffrey Gertz there of the Center for a New American Security. You're on the same page. It was ridiculous.
Absolutely. But I also think that both these administrations could learn something from each other. Sometimes the Trump administration just floods the airwaves, and maybe a message they're trying to get across is diluted because there's so many people speaking at the exact same time. The other hand, you have the Biden administration, which really was very shy.
It was preachy. It wasn't shy. It was preachy.
But shy from even wanting to engage and do interviews. I mean, how many times have we sat down with the current Treasury Secretary, Scott Bessent?
Countless.
More times than I even had FaceTime with Treasury Secretary Janet Yellen.
And they'll take firm questions, too. I've always said that. I said the same thing about Larry Kudlow in the first term for President Trump. There was something about the former administration where they just believed that everything they knew was better than what you know, and that there is no space for conversation because what we say goes. And that's basically it. And trust us because we're right. And that was their approach to inflation as well. Inflation's not high. I'm going to tell you what inflation is. And the rest of the country was, well, actually, I'm really squeezed right now. This isn't working for me.
And then at some point, that's why they had to recalibrate on a number of fronts, including President Biden going to Saudi Arabia and asked them to have more oil because he had to bring gas prices down. But even just yesterday, just from a journalist perspective, 3 hours, 16 minutes, there was a lot of noise in that cabinet meeting, but that is not something you would experience under the Biden administration.
That's the latest on the politics and policy. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. The European Union will try to fast-track legislation to remove all tariffs on U.S. industrial goods by the end of the week. President Trump is requiring the removal before the U.S. lowers its duties on the bloc's auto exports. The European Commission will also give preferential tariff rates on some U.S. seafood and agricultural products. Meanwhile, Lego posting record-breaking sales in the first half of the year, boosted by its brick flowers and cars. The Danish toy maker expanded its market share in every major geography, but said Asia is playing a very important role in its strategy. Lego CEO said there are a lot of children in Asia and living standards are going up. That makes Lego more relevant. And Elon Musk's SpaceX Starship successfully launched its 10th test flight and deployed satellites for the first time. Starship is the centerpiece of the company's plans to send huge batches of its Starlink internet satellites into Earth's orbit and carry humans to the moon and eventually Mars. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Up next on the program, the pressure building on the Federal Reserve.
This is really an unprecedented attack on the independence of the Federal Reserve, which means higher inflation potentially, less credibility, even higher long-term interest rates, bad for the economy.
Up next, Krishna Memani of Lafayette College from New York. You're watching Bloomberg TV. Equities positive by 0.1% on the S&P 500. Drama in Washington, no drama on Wall Street. Very close to all-time highs coming into Wednesday. Under surveillance this morning, the pressure building on the Federal Reserve.
The Federal Reserve is in an incredibly difficult position here, but you have to remember, this is not about an individual governor. This is really an unprecedented attack on the independence of the Federal Reserve, which means higher inflation potentially, less credibility, even higher long-term interest rates, bad for the economy.
So here's the latest this morning. The bond market in focus as President Donald Trump and Fed Governor Lisa Cook gear up for an intense legal battle following the move to oust the Fed official. Krishna Memani of Lafayette College writing, why is the long end so stable? The only possible reason I can come up with is that the Trump taco thinking permeates bond markets. That includes all the machinations related to the Fed. Krishna joins us now for more. Krishna, good morning.
Good morning.
Is that your take on things this morning, then?
Well, so, you have to ask yourself, if this Fed independence issue is really that important, then it ought to have a really substantially more impact on the bond market than it has had so far. And why is that not the case? And again, I can come up with 5 reasons. None of them actually stick. So the only thing I can think of is the markets are basically saying, okay, if things move in the wrong direction on a sustained basis, then maybe all of this gets pulled in.
Let's play this out. Let's say there was a complete takeover of the Federal Reserve. Mm-hmm. Absolute fiscal dominance. Mm-hmm. The first thing I'd be expecting was massive bond buying, yield curve control.
Well, I think if they don't do yield curve control in that environment, long rates are going to be meaningfully higher. There's no doubt about that. And Summerlin actually wrote an op-ed not too long ago, and he's one of the candidates basically saying exactly the same thing. That is, if fiscal authorities take over a central bank and they want to control rates, so, we have seen that 15 different times in different places.
I'm surprised more people aren't thinking about the post-Powell world. They're still thinking about the post-Powell world with a Chairman Powell way of thinking about the world. In the post-Powell world, you've got to believe that the president is going to want lower borrowing costs for the government and lower mortgage costs for consumers. And with that in mind, shouldn't we be thinking about more activist central bank balance sheet policy?
Well, so I think activist central bank policy to what end? That is, what is the...
Lower mortgage rates, lower borrowing costs.
Well, that's not what the Fed's mandate is. The Fed's mandate is employment, inflation, and the inflation part hasn't gone away. And old stalwarts like Waller, I think in that scenario, will probably exert themselves more, much the way they're exerting themselves.
Think about a way to justify this. It would be pretty straightforward. Danny Berger was talking about this on the programme in the last week. You could say, I'm looking at reducing interest rates, but it's not leading to a drop in long-end rates. Therefore, I'm seeing the bond market, the global bond market, impede the efficacy of domestic monetary policy, and it would be helpful to use the balance sheet to address that concern. Isn't that the way to get around all this?
Well, so I think if you think about it, that's what QE was about a little bit on the other side. So yes, you can justify it, but I think from an economic theory and policy standpoint, I think it would be really hard to justify in light of the data at that particular time. And that data and that particular time in that environment probably wouldn't be as supportive as it is today to that cause.
You mentioned Governor Waller. He's just one individual on the list, though. What if there was someone that is to Jonathan's point, thinking about how this administration would want to bring long-end yields down and mortgage rates down?
Well, so I think, as Waller has articulated, that if the environment is right, we shouldn't be too restrictive because it ends up causing problems for the economy. I think in a scenario where you're basically forcing rates down through yield curve control, that would not be the case. So yes, they can sign up for that policy, but it would be very difficult for them to justify it on economic grounds rather than just a political move. And the one thing that you have to kind of give to this administration is, if they focus on some things, they will go all in. And we should, in a dire scenario, we should probably expect that.
When it comes to Fed independence and Governor Lisa Cook, if the court says that she's in her right to say and the president cannot remove her, what happens next?
Well, so I think if it would be very difficult for somebody to remain very credible in that sort of a situation.
So you think she goes regardless?
I think she goes regardless, but I think she goes after a fight.
Should we get to the market call?
Yep.
Stocks or bonds?
Stocks. If I had to buy something, I would rather buy stocks rather than buy bonds.
Why?
I think the risk of reacceleration is probably not being discounted in the market appropriately.
So you see it in certain places in the stock market, small caps, banks, seeing it in some cyclicals, seeing it in the airlines too. You think that can continue?
I think if my guess is right, I think the economy is not slowing down. Put aside inflation for a second. Economy is not slowing down, and it is really supportive of the cyclical sectors. Whether we'll get the oomph that we are looking for, that remains an open question. But I think the cyclical part of the economy is doing much better than we give it credit for.
So just as the Fed's about to cut interest rates, you're expecting a reacceleration in the US economy.
And I think that's why it'll probably end up being one and done rather than what the bond market is thinking about.
So one and done for this year or for the whole of next year too?
No, I think more this year. It's a very dynamic economy. Things could be materially different next year. Unlikely, but could be.
I struggle to believe the incoming Fed chair, whoever it might be, won't be cutting interest rates in 2026.
Well, again, I have a lot of confidence in the other members, Waller, Bowman. I think they will do the right thing for the environment. I think Waller has an aspiration to be the chair. If he's the chair, then, I think we'll be golden.
When you say oomph to the economy, how is that going to happen when consumers might start pushing back? We've seen it in some sectors on higher prices.
Well, I think consumers have started pushing back. But if you look at something like Bank of America credit card data, they are better this month than last month, and last month was better than the month before. So I think the consumer slowdown is people kind of taking McDonald's data and extending it too far.
Krishna, it's good to see you.
Thank you.
Thank you, sir. Is that what we're calling BLS data? Or just McDonald's earnings? OK, I don't want to go there. You don't either. Krishna Memani of Lafayette College, the third hour of Bloomberg Surveillance. Up next.
Everything is expensive right now. We should expect lower returns across the board, both from stocks and from bonds.
When I look at the S&P 493, there's a lot of businesses in tech hardware.
You don't want to have a scenario where tech and tech capex slows down.
We saw a really good earnings season, and some of that has been baked in NVIDIA stock.
It's starting to feel to me like we are paying 20, 30 prices for 2025 technology.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now as we count you down to the opening bell. 90 minutes away. The price action, your scores look like this. Equity futures on the S&P 500 firmer this morning by not even 0.1%. Similar move on the Nasdaq 100 after a period of outperformance on small caps in the last 24 hours. We're a little bit softer this morning, down by 0.1%. The main event later on this afternoon after the closing bell, earnings from NVIDIA. The bar is always high.
The bar is very high. What you've been saying consistently, I think, is really important. The question going into this when it comes to China is not even so much what NVIDIA is able to sell into China. It's what China is willing to take at this moment. Do they even want the chips anymore? And then I think when you look at potentially how Jensen Huang is going to talk about China, where is he right now with this administration in potentially getting export licenses to sell something like a Blackwell chip into China? And then the follow-up question has to be, well, what are they asking you in terms of profit if you're allowed to sell that chip into Beijing.
I joked yesterday that Nvidia makes up 8% of the S&P, 10% of the Nasdaq, and 110% of investor sentiment. But this market's far more than just about Nvidia right now. Small caps, banks, home builders, airlines, all rocketing over the past few weeks.
And what did we just hear from Krishna Memani? He thinks that there's an oomph right now in the economy and there's still more to go, which is why at this moment you asked him, are you equities or bonds? And he says it's equities.
Krishna Memani on the programme 10 minutes ago, looking for the Federal Reserve to drop interest rates just as the economy is taking off and rebounding into the back half of the year. Big call. Equity futures right now in the S&P just about positive. Coming up this hour, Alex Altmann of Barclays with stocks near all-time highs. Gil Luria of D.A. Davidson as investors are bracing for Nvidia results, and Matt Luzzetti of Deutsche Bank as he ramps up rate cut bets. We begin this hour with stocks close to all-time highs ahead of earnings from Nvidia. Alex Altmann of Barclays writing, with the backdrop of a long weekend approaching in the US and low volumes, may simply be enough for risk to continue rallying in the wake of these results. Alex joins us now for more. Alex, good morning.
Good morning.
It's good to see you, sir. This market is not just about tech and Nvidia. What did you notice in yesterday's price action in small caps and in rates?
So not just yesterday, this has been on for really a few weeks now, and what we think is important is to talk about potentially a regime shift within the equity market, and that is effectively moving from a post-COVID environment or post-inflation environment of higher for longer and into something that looks different, i.e. lower interest rates. And I don't necessarily mean that we're going to suddenly drop back to a zero interest rate world. But if we're just on a path towards more gradual rate cuts, we have to consider there has effectively been a K-shaped recovery in the economy for a number of years now. Small caps have been suffering for a very long time. Is it their time that actually they start to outperform because they are the biggest beneficiary of interest rate cuts?
Let's just sit on the why, and why short rates. Because if you look across the curve right now, yes, a lot of people are convinced the front end yields are going to drop. The long end remains a debate. Why are short rates at the very front of the curve so important to small caps?
Very simply because you're looking at between 45 and 50% of the Russell 2000 debt is variable rate. So, and then if you look at the overall weighted average maturity of Russell, including that, you're looking at probably somewhere between 3 and 4 years. So the front end of the curve really matters for Russell, and that's not to take away from back-end rates. 10-year, 30-year can obviously affect the broader risk sentiment. It's more the fact that if we just operate in the environment of the back end of the curve being relatively stable, and we can talk about the independence of the Fed and whatnot as well separately, ceteris paribus, if the front end of the curve comes down, that means that it's going to be a direct beneficiary for small caps. Who owns small caps right now? No one. It's one of the biggest underweights that we've seen in our data for an extremely long time.
Let's talk about the independence of the Fed, though, and what that means for the long end. We have seen a steepening, but it's been quite muted. If you are really concerned about the independence of this Fed, why are we not seeing a bigger market reaction?
I think that in itself is a really good question. We could obviously just say there's a degree of investor lethargy, apathy. It's the summertime, and they're not really going to do anything until everyone comes back from Labor Day. But I also just think we have to work off the assumption it's really easy to extrapolate this narrative into these doom-mongering forecasts into the future. But you have to also remember that we are operating with an administration. The commander of the United States often says things and doesn't do things. And you have to take him often very seriously, but not necessarily literally. And right now, I think that we're in that environment where the market is still trying to grapple with what is Trump actually saying and what does he end up doing? Case in point, and I know this is a dramatic tangent, but whatever happened with Greenland, for example? We don't talk about that anymore. That was going to become suddenly the 51st state. So I just think that we just need to sort of like pump the brakes a little bit.
You're talking about this idea of taco. Trump always chickens out, but he hasn't in a lot of respects. People never thought we would bomb Iranian nuclear facilities the way this administration decided to do so. So how do you know which Trump you're going to get, at least when it comes to the Federal Reserve?
I don't think you do. But at the end of the day, I think we have to trade the sequencing and not necessarily what the end goal is going to be. I think if we start trading end goals, I think if nothing else, this Trump administration has taught us that effectively we're operating in rolling 4-week windows during the course of 2025.
I think it's 2 weeks, but yeah.
Sure, but you see, and that was one of the tongue-in-cheek things that we as a team sort of thought about and said at the beginning of the year is that actually every trade that we talk about is probably good for about 4 weeks, and that's about it. And sadly, is still the environment we're operating in right now. So I can't say what the end game of what this Trump press on the Fed is going to look like. I can just effectively try and make forecasts for the next 4 weeks, and I would say the next 4 weeks probably looks still relatively benign.
Well, that's your seat, tactical strategies. So just share the sequencing with us. How are you thinking about the sequencing of things with regards to the Fed?
Well, so I think that obviously the first comes first, we're going to have September data, so we're going to get the monthly cycles. We'll have payrolls, we'll have the ISM, we'll have retail sales, the CPI and whatnot. Payrolls, for example, actually the alternative data, if you look at sort of ADP forecasts, 4-week moving average of jobless claims, all of that is looking relatively benign. So we should actually get a relatively okay number based upon this sort of early indication. And that then sort of ties into, okay, so does that mean the SEP for the Fed in September means we get the 25 basis point cut, but it is more of a one and done, as the previous commentator just mentioned. But again, we're talking about something that's already 4 weeks away. There's too much information to try and make bold forecasts that far. What I can tell you is that we've built a relatively robust equity timing indicator, sort of using a bunch of market variables. And right now that's telling us that actually it's still a relatively favorable environment to be invested in US equities over the next 4 to 8 weeks.
When you started talking about payrolls, one of the first things you did was talk about alternative jobs data. Now, I just wonder if you're seeing investors engage in the situation in the same way. Are they starting to look at ADP as event risk on the calendar now?
Yes, they are. And I don't think that's necessarily an entirely new phenomenon. If you actually look at the trajectory of ADP over the past 9 to 12 months, it's actually been okay. I wouldn't say it's been the perfect forecaster, but it's one of the inputs that you can use along with jobless claims, along with NFIB hiring intentions. There's a variety of different measures you can amalgamate together to help get a reasonable picture of what the job market looks like. And obviously with payroll specifically, there's this big birth-death adjustment, which is hugely volatile. One of the actual reasons why there's been so much criticism of them. And so consequently, I think that you do get this volatility in payrolls, especially at a time where we're only generating about 70 to 100,000 jobs a month. And in an environment where immigration has collapsed, it does leave us vulnerable in general to a potential wobbly payroll print. But again, that's in the context of the standard deviation of the number, it's very hard to forecast.
Are you almost ignoring the inflation reports?
I'm not ignoring the inflation reports. I try to take a step back, is that if, I know that we can't think about it just like this, but let's say we were in a world where we didn't have tariffs. What would inflation really be looking like? So I really point at the biggest component of inflation is, of course, housing, lodging, that kind of stuff, rents. If you look at the Cleveland Fed's own data of rent, new rents, it's down 9% year on year. And all rents are only up 2.5%, which is basically in line with where it was pre-COVID. So the biggest part of that inflation component is not really anything particularly dramatic. So if you put tariffs to the side for 1 second, because quite frankly, I don't think anyone knows what the inflationary impact of tariffs is going to be. I actually don't think the inflationary backdrop for the US right now is anywhere near as egregious as some commentators would say.
So that basically means the Fed really does have an open door for September.
I think they do have an open door for September. Barclays economists are one of the few holdouts that wasn't going for the September cut. They've now changed to a September cut, so that looks like it's pretty much a lock. And after that, I think we should try and take a step away from what October or December looks like, and instead, Jonathan, like to your point, just think about what a post-Powell Fed looks like. And this matters for stocks. Stocks are supposed to be forward discounting mechanisms. And so this comes back to my small cap point. I don't think it really matters enormously whether they cut in September or December. If the path of interest rates is lower and we have a line of sight on lower interest rates in a post-Powell world in 2026, then we have to assume that parts of the economy that have basically been in low growth or even recessionary environment for 2+ years now is going to start to get some reprieve, and investors are not positioned for that.
You don't have to wait for 26 for that. We're going to find out who the next Fed chair is going to be in the fall of this year. And whoever that person is, I don't think they're going to be quiet about what they think should happen to interest rates and everything else for next year and beyond.
Absolutely not, because the names on that list have already been making the rounds, including on programs like this, talking about what they would like to see at the Federal Reserve. And what did we just hear from Marc Short, who was in the room? His VP was in the room, Trump 1.0. One of the biggest issues going into whether or not Donald Trump was going to choose you as Fed chair was a key question. Are you going to cut interest rates?
Last time you were with us, you talked about just how much volume, a big chunk of volume in this equity market was going through a handful of names that make up a couple of basis points of total equity market capitalization in this country. You still seeing a similar dynamic?
It's definitely come off the froth and off the boil, whether that's a function of just, again, a summer lull. We often see a pickup in retail enthusiasm again in the autumn. It's like a last hurrah before the end of the year, and then the beginning of each year tends to be a slowdown again. But the short answer is no. We have seen a pickup in activity, of course, in small caps. And last time I was here, we did talk about that too. And so I do think it's not just about retail what's going on. I think there's something that's bigger that's happening. And again, that's why I want to sort of insert this vernacular of potentially a regime shift.
We heard the pitch. We got it loud and clear. Appreciate it. Thank you, sir. Alex Altmann there of Barclays on the latest equity market moves and the outperformance we've seen recently in small caps. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara for more. Hey, Yahara.
Hi, John. President Donald Trump saying he's prepared for a legal fight with Fed Governor Lisa Cook after he attempted to fire her. This as Cook's lawyer vowed to file a lawsuit over Trump's move. The Fed said it would abide by any court verdict and deferred any decision on Cook's current working status. Meanwhile, shares of peanut butter and jelly maker J.M. Smucker are falling 3.2% in the pre-market. The company reported first quarter net sales that missed estimates. Smucker said coffee, dog snacks, sweet baked goods, and fruit spreads were among the areas hit by lower demand. It has also been battling the impact of higher coffee costs due to President Trump's trade policies. And in sports, Iga Swiatek and Jannik Sinner are advancing at the U.S. Open after handily winning their matches. Sinner is aiming to become the first repeat champion at the U.S. Open since 2008. Elsewhere, 45-year-old Venus Williams will continue her bid for a trophy after being awarded a wild card entry into the doubles draw with Leylah Fernandez. Yet all the focus has been on Alcaraz's buzz cut. That's your brief. John?
I noticed the same thing. Yeah, I mentioned it yesterday too. Kind of shocking. I think he looks good. It's hard to argue with that.
Yeah, I don't know. Maybe it helps him play better.
Shaved head, looks shredded. Probably going to win the US Open. Up next on the programme, the morning calls. Plus, Gil Luria of D.A. Davidson as investors are bracing for results from Nvidia. That's coming up later on this afternoon from New York City this morning. Good morning.
Take rates down by 50 basis points, 75 basis points, you're getting in the 3.5% range. I think that's okay. The market's willing to absorb that based on what's happening with the labour market at the moment. If you're seeing actually a stabilisation in the economy, maybe even a little bit of a re-acceleration at the same time as we still have inflation north of 2% and above the Fed's target, I think that's when questions will be called as to whether they need to go any further.
That was Iain Stealey of JP Morgan Asset Management joining us a little bit earlier this morning. If you are just tuning in, good morning to you all. Here's the state of play. Futures just about positive going into earnings from Nvidia later on this afternoon. Equities up by 0.1% on the S&P 500 and on the Nasdaq 100. That's the price action. Here's some morning calls. First up, HSBC upgrading Eli Lilly to hold, seeing upside potential to consensus estimates. Your second call from Goldman Sachs downgrading Deutsche Bank to neutral, citing its current valuation and significant outperformance so far this year. And finally, JP Morgan downgrading Krispy Kreme to underway, seeing execution risk in the company's turnaround plan. That stock is down by more than 6%. Let's stick with tech, or turn to tech. Nvidia's highly anticipated earnings expected to give insight into the durability of the AI spending boom. It's the main event in this market worldwide. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, good morning. It's good to see you. Set the stage. What are you expecting?
Well, so they actually wrote down the H20 revenue last quarter, and so the expectations for this quarter of around 45 to 46 billion, they will beat by at least 2 billion plus. It's the next quarter. So consensus right now is around 53. I think the buy-side bogey is more 54 to 55, and they will likely exceed it. So from that perspective, the numbers will look good. The key question that I have for, I guess, NVIDIA and investors are looking at is the models haven't converged in functionality. So if you compare ChatGPT to Claude to Anthropic and Gemini, they have not converged. If compute was the real constraint and everyone can use, NVIDIA GPUs to kind of converge the model functionality, then yes, compute is where the answer lies. I think the market is more gravitating towards better data. And that is where if you're optimizing for better data, I think some companies have started looking at that more closely by use case. So you need better data for coding agent or for search. So depending on the use case, you need to create that data. And in that scenario, I think NVIDIA will see some slowdown. I mean, the growth rate will still be great. But that, to me, is the real crux of what will determine the growth going forward.
Mandeep, stay close. I want to bring in Gil Luria as well. He joins us from D.A. Davidson, has a neutral rating on NVIDIA with a price target of 135. Gil, I've got to say, 135 these days sounds like a sell. So talk to me about the downside risk going into this event.
Yeah, that price target was set 3 months ago when the stock was a little lower than that. So we have had a lot of positive developments in the sense that the models have gotten a lot better. To your point, a lot of models have gotten better. They're comparable and they are far more competent and useful. The adoption for consumers and for employees is happening very quickly, which means the demands for compute from the hyperscalers continue to go up. And that's really all that matters. That is why they should be able to comfortably hit their numbers for this quarter and probably guide pretty well for next quarter. The only noise right now is around China. That's not a demand issue. That's how many chips can NVIDIA sell in China, which chips, how much taxes are they going to pay on them? Will they get the next generation of chips approved? That's really the variability around the results. If we, even 3 months ago, thought that this may be peak year for demand for NVIDIA, we no longer think that. The AI models are so powerful, driving so much demand that we do expect them to grow into next year.
And as Jonathan's been saying, another key question for China is whether or not Beijing even wants the chips. So how do you start to, at least in a model, thinking about what they report tonight, think about what are they going to say when it comes to profits from Beijing?
Well, that is a very big question because the news flow is daily on that front. Now, let's be clear. China needs the chips right now, and Chinese companies need the chips right now. They are ramping up domestic production from Huawei. Those chips are catching up in terms of functionality. But right now, both American and Chinese companies have insatiable demand for these chips. So they'll take any H20s they can get. China is just signaling that they got upset over the fact that we started putting trackers into our servers, into those H20 servers. The US was concerned that we are sending chips to resellers in other parts of Asia that are ending up in China. We started putting trackers in those servers and chips in order to make sure that smuggling isn't happening. The Chinese got upset over it. They're saying they're warning their companies not to buy chips and servers with trackers. It's just adding to the drama. Not sure Jensen Huang himself has visibility into how that's going to play out. Again, it'll continue to be a source of noise.
Well, you think Beijing is just posturing? Because there was a recent report that NVIDIA told its suppliers to halt component production for the H20s.
Well, we'll find out. We'll find out today. And again, the H20 is going to add noise because those chips were entirely written down. So they should have come in at 100% margin. And now there's a 15% tariff on them. There may be some customers in China that have listened to the government and will pause their buying. Maybe they're waiting for the B30, which will be approved. Maybe there's a negotiation of whether or not there's trackers in there. We may get some of that today, but the company's actually been very guarded about what they say about China. So we may leave tonight not knowing any more than we know right now.
Gil, I'm always thinking about the what if further down the road. Can you imagine a scenario where NVIDIA just doesn't have a presence in China anymore and has to choose a market to be in?
Yeah, and that future is quite possible. I think the analog is Apple, right? Apple, China used to be more than 20% of Apple's sales. That's been declining every year with domestic competition. So the Chinese are allowing iPhones in, but promoting and encouraging the domestic maker, also Huawei, Xiaomi, to sell the phones there. I would expect a similar picture for NVIDIA. The Chinese market will grow very fast. Their share within China will decline over time. And really the battleground is countries like the Gulf states and Europe, where NVIDIA will try to hold back the Chinese makers from gaining market share there. And the government the U.S. government is trying to help them with that.
Gil, we saw that play out earlier this year. Appreciate your time, sir. Gil Luria there of D.A. Davidson on NVIDIA. Mandeep, just to explore this a little bit further, China is a risk factor, counterbalanced by maybe sovereign demand elsewhere in the Gulf. How do you think that's going to play out?
It absolutely will. And in Saudi, they are building 200 megawatt data centers. Most likely, they'll end up using NVIDIA and AMD. But look, when you are dealing with such large numbers, $200 billion business growing at 50%, if capex of even one of the hyperscalers goes down, it's not 30-40% growth next year, that will have a bearing on NVIDIA, even with the sovereign demand. Because if China is not panning out, they have 10 or 15 customers that drive the bulk of the data center revenue. So we have to closely watch out for each of these model providers, where they are with respect to their model functionality, and how much are they willing to invest in NVIDIA GPUs.
Gil said that he thinks there's going to be approval for the B30. What kind of advanced technology does that chip have over the H20?
I mean, I think Blackwell's, which is the new version, will have somewhat of a version which is not as advanced as what they're selling in the US and the Europe markets. That's what they will package in the B30. But, the talk about NVIDIA giving 15% of their revenue to the government, I mean, these are the sort of things I don't think it's likely, but you never know. And from that perspective, the China market is so hard to model for NVIDIA that if you're an investor, you want to X out the China number and see what the real growth rate is. And I think that's what the investors will focus on tonight.
Mandy, one conversation we had a little bit earlier, it's not a conversation for tonight, but maybe further down the road, energy constraints and the backlash you could see from consumers, citizens of countries like this one and elsewhere.
Actually, that could be a positive for NVIDIA. The reason I say that is because the next version of their chip is more optimized for power and performance. So if there is a real bull case, to me, that is the power constraint. And you're absolutely right. There will be a lot of pushback on, power. So if the chip is more optimized for power, that actually goes in NVIDIA's favor.
It's a good point. It's going to get expensive and more expensive, and it already is.
It already is getting expensive, and already this is becoming a huge issue in Washington, D.C., with lawmakers talking about the fact that small businesses, individuals are seeing higher electricity prices. And the president talked about this yesterday in his cabinet meeting, this Mark Zuckerberg photo that was sent to him, a data center the size of Manhattan.
Huge.
Being opened up in Louisiana.
Mandeep, it's good to see you. Thanks for dropping by. Mandeep Singh of Bloomberg Intelligence looking ahead to earnings from NVIDIA after the closing bell. Up next, Matt Luzzetti of Deutsche Bank as he's ramping up rate cut bets. Plus, we'll touch base with Danny to get your morning movers. Live from New York City, welcome to the program. 60 minutes away from the opening bell. Futures look like this on the S&P 500, just about positive on both the S&P and on the Nasdaq. Going into the big earnings report later on this afternoon after the close, numbers from NVIDIA. Let's turn to the bond market. 2-year, 10-year and 30-year just sit on the front end of the curve. Earlier on today on twos, 364. That's a new low post payrolls. Right now down about 2 basis points, 365.56. This curve steeper with the long end, 30-year bond yields higher by 2 basis points, 4.94. That theme continues. That's the price action across stocks and bonds. Let's get you some single names, some morning movers. Here's Danny. Hey, Danny.
Hey, John. Just a trickle of earnings this morning, including JM Smucker. A disappointment it missed on its current quarter. Shares are down 2 3/4%. All of the areas from coffee to snacks to baked goods, all of them looking weaker. Coffee in particular has been a problem with them given higher costs with the tariffs on Brazil. They're talking about a dynamic environment is what the CEO cited. Kohl's also reporting earnings, but they had a brighter than expected outlook, upgrading their full year forecast. Shares are up 21.4%. It is a turnaround that appears to be taking hold. And crucially, they also upgraded their margin outlook, something that's important for a lot of these retailers with concerns around the consumer. Now, elsewhere, Canada Goose shares, the parka maker, those are moving much higher as well, nearly 15.5%. CNBC reporting that they are receiving interest of a take private. Their controlling shareholder is Bain Capital, a private equity firm themselves. According to those reports, Boyu and Advent among the PE firms looking at potentially taking Canada Goose private for $1.35 billion because, John, apparently no companies want to be public anymore.
Danny, how many times have we seen this month alone?
It's like every single day. Every day feels like a new one.
Amazing. The latest Canada Goose there. The speculation around that company. Danny, thank you. Let's turn to the economy. Investors are waiting. Key inflation data due out on Friday as President Trump ramps up pressure to oust Fed Governor Lisa Cook and pack the Fed with doves. Joining us now is Bloomberg's Mike McKee, who has more. Good morning, Mike.
Good Good morning, John. Well, the PCE income, spending, and inflation numbers will come out on Friday. Small changes are expected, but in the wrong direction. We're expecting to see inflation rise a little bit. This is one of those indicators where economists are pretty good at forecasting it, and so it becomes something of a non-event, at least for the Fed. But the income and spending numbers will also play a role, particularly spending, because that's the follow-on to the labor market. If people have jobs, they have money, and they spend. If they start cutting back, then that's something the Fed's going to worry about. And meanwhile, we have to continue to worry about what's happening in the Lisa Cook situation. She says she's going to go to court. We're waiting for a filing. She'll ask for an injunction to prevent the president from removing her from office until all this is adjudicated. What we've seen in the past with Trump's attempts to fire people is that they get the injunction and then an appeals court either upholds it or throws it out. And then they go to the Supreme Court, and the Supreme Court has generally ruled for Trump. In this case, I think that's kind of hard to see happening in that the court has already said there is an exception for the Fed. They have to be fired for cause. And so far, there's no proof that she did anything. There are just allegations.
Mike, super messy. Very messy situation playing out. You know the institution better than most. What's your response been to their reaction in the last 24 hours?
I understand their reaction, and I've talked to people there about it, and basically their situation is they don't know what Lisa Cook did or did not do. They don't have all the facts. They're waiting for her to tell them as well. And so they can't come out and publicly defend her at this point, but they don't want to cut her loose either because they know this is a major attack on the Fed itself. So they're in something of a dilemma. If they feel that Cook is innocent or her mistakes were minor, then you will probably hear Powell and others come out to defend the institution itself. The bottom line question over the long run is if he did get rid of her, would that keep Jay Powell on the Fed when his term as chairman is over? Would he stay until his term as a governor is over in 2028 just to frustrate the president?
It's something we still don't know the answer to. Mike, can we just sit on the legal situation? And I certainly don't expect either of us to litigate it right now live on TV. But we don't have an official opening of a legal investigation into these serious allegations of fraud. Do we know how Governor Cook has responded herself internally with the Federal Reserve leadership? Has she presented anything to them to deny this? Because publicly, we haven't had a formal denial.
Well, she had not as of the time we were in Jackson Hole. She may have in the last 24 hours. One of the things she had to do was get a lawyer. She has one now, Abby Lowell, who is advising her on how to handle all this. But remember, one of these properties was in Ann Arbor, Michigan. One was in Georgia. And she has to collect the data, the paperwork from both of those. And that could take a little bit of time if she doesn't have it handy because she moved to Washington and left it somewhere or something like that. So I thought we might go into this week without the president making a move, but he didn't wait. You'd think he'd want to wait until at least there was some evidence, but so far, he's moving right ahead.
Mike McKee, thanks for the latest. Appreciate the update from Mike McKee on the Federal Reserve. The pressure keeps building. It's going to take a long time to play out, based on the latest moves.
It's going to take a long time to play out because this is going to go through the courts. What's interesting, though, is if she gets this injunction, she's able to continue working. How ridiculous, almost in a way, is September going to feel? That press conference, Chair Powell is going to have a lot to answer for, and I don't think just a one-word answer is going to do it for the press.
September 17th, keep repeating the date. Federal Reserve meeting less than a month away. Let's turn to interest rate expectations. Matt Luzzetti of Deutsche Bank writing the following. We now see a 25 basis point rate cut in September as most likely. After that, we see the Fed delivering 25 basis point reductions in December and in March. Matt joins us now for more. Matt, good morning.
Good morning.
So this was a change. You weren't expecting anything in September. Jackson Hole happened. Talk to me about why that was so important.
Yeah, we had previously expected the Fed would wait until December to cut rates, and we had them then cutting December, January, and March by 75 basis points. And our view was that the labor market, although slowing and weakening, was hanging in well enough to keep the Fed on hold, but that also that we were getting some troubling inflation data. We saw it out of the PPI recently. We'll see it, I think, again from core PCE later this week. Inflation around 3%, the unemployment rate near 4.2%. The argument for cutting in September was not all that strong. Now, in Jackson Hole, I think we got a signal that Chair Powell was leaning in that direction. I think he indicated two things. One, the balance of risks is shifting. He's a bit more worried about the labor market. And two, that shifting in balance of risks could warrant a policy response. And so we took that as, I think, evidence enough to pull forward a rate cut to September.
What about as well the fact that Jay Powell basically said you can look through inflation prints? So this jobs number is really important. What if it comes out pretty strong?
So I think if this jobs report comes out pretty strong, it probably more tells us about October, December, and Q1 rate cuts than it does about September. I think the signal from the chair at this point was, look, we're still restrictive at this point in time. We have some way to go towards neutral. You're right. I think he had more dovish comments on the inflation side. A lot of the language was the same, but he adopted an argument from Governor Waller, which was that as long as the labor market is not overly tight, this is probably not going to be a persistent inflation shock. And so I think if you get a strong jobs report, it'll be viewed in the context of the jolts and the QCEW data that we get, which will point to downward revisions. But I think more that'll say, is the Fed cutting in October, December, and Q1 rather than September?
That word restrictive, I think they could all agree at the moment they believe they are restrictive. When does that conversation get a little bit more tricky on the Federal Reserve? Is it another 50 basis points, 75 basis points? When does that conversation get harder?
Look, I think that conversation is already tricky for the Fed. I think it's tricky from the types of indicators that we look at. On many indicators, the Fed is not meaningfully or modestly restrictive. They're probably close to neutral. One thing that we look at are financial conditions. On the Fed's own measures of financial conditions, they're the easiest that they've been since the Fed started raising rates in early 2022. In that context, they are probably not all that restrictive. Now, Powell has to balance this amongst the committee, which is, I think, increasingly divided on all key issues, including where they're on neutral. And clearly, Powell took a stand here. He was not in the camp of those hawks that think that we're at neutral or very close to it at this point in time. He thinks that they have at least a little bit of space to cut rates.
The New York Fed President, John Williams, weighed in on some of this. Is he an outlier, or do you suspect that's the core view on the central bank?
So I think John Williams, the history here is that he has two of the canonical measures of R-star. And those two measures do still show neutral R-star at low levels, not as low as it was pre-pandemic, but still at historically low levels. My view is if you look at kind of a suite of indicators that are out there, neutral is higher than what those indicators suggest. And you can see it from term structure models, market pricing, other Fed models that are out there. And so I just think that the balance of evidence is that R-star has moved meaningfully higher relative to where it was in 2020.
If they're cutting, though, in what you think twice this year, 2026, when the president says he's looking forward to having this majority at the Fed, how much room do they actually have to cut?
It's a great question. And the market, although we've seen a move lower in the front end of the curve, the market is still basically pricing a 3% Fed funds rate next year. Now, that sounds aggressive to us because we think neutral is higher. But the Fed's long-run dot and their guidance on neutral is still towards 3%. So it's not really outlandish. We have not built in any change in reaction function for the Fed next year. And so we have the Fed stopping in March between 3.5 and 3.75% rates. I think as you see some shift in the Fed personnel, as we get a sense of who the new Fed chair will be, we might very well have to build in a more dovish reaction function because that's likely where it's moving.
When you look at potentially the names that are being floated around, who do you think's the dovest of the dove?
So I think it's hard to know. I think the arguments that we've made for a few months at least is that Governor Waller seemed more likely than other candidates to us because it's not just how dovish are you. I think it's whether or not you can get the rest of the committee on board for your dovish arguments. Can you bring together a very divided committee to forge a consensus or a majority towards those cuts? And I thought Governor Waller was kind of well placed to do that. I think over the past few months he has made that argument. Certainly after dissenting in July, getting some weaker labor market data, I think that's helped his prospects.
Chairman Powell's speech speaks for itself. Annmarie said it, I think we all have. It sounded like something Governor Waller had written himself, particularly on the labour market. And I'd love to finish there with you. Just your views on the labour market and how they contrast with the chairman's view at the moment, which seems to have changed. In the news conference, he anchored his view on the labour market, which he called solid, around the unemployment rate. And the general view from some economists, I'm not sure if that includes you, but it certainly includes some on Wall Street, that yes, we had a step down in payrolls growth, but ultimately we hadn't seen an increase in labour market slack, and measures of slack had remained stable. That doesn't appear to be something he's putting a lot of weight on. Is there some daylight between you and him at the moment on how you view labour?
So I think there's nuance in his comments. I think he still pointed to the fact that the unemployment rate and measures of labour market slack have not moved higher. At the same time, I think he has noted that the pace of the downgrades on the payroll side increases downside risks. And with those risks, even if your view is that the baseline is solid, it makes sense to take out some insurance in the near term. I would generally agree with that view. We view the quits rate and the unemployment rate and job openings to unemployed as being very stable over the past year. We think payroll gains could be 50,000 and keep those measures stable given what's happening on the immigration
front. Just 50K.
50K could be lower, given what's happening on the immigration side. But I think it makes sense from monetary policy as you're balancing the risks. You would want to get some clarity that we're stabilizing around those levels rather than continuing to see payroll gains fall.
What's your guess for next Friday?
We haven't put out a kind of a preview yet. It's a little bit too early. But I would anticipate maybe two things. One, that you do get a little bit of a bounce back in the payrolls data.
Okay.
ADP was actually pretty solid last month. When you look at the jobless claims data, they've remained solid. The other data point that I would mention is a big part of the unemployment rate last month was this surge in new entrants. It was a record surge that happened. Oftentimes, as that happens, it gets reversed the next month, and you have downward pressure on the unemployment rate. So those two things suggest a reasonably solid jobs report next.
Matt Luzzetti of Deutsche Bank. Matt, appreciate your time.
Thank
you, sir. Let's give an update on stories elsewhere this morning. Let's cross over to Yahira to get your Bloomberg brief and a news update. Hey, Yahira.
Hi, John. President Trump is stepping up his efforts to exert more control over the central bank. Sources telling us here at Bloomberg the Trump administration is reviewing options for exerting more influence over the Fed's 12 regional banks. That would potentially extend its reach beyond personnel appointments in Washington. Meanwhile, we are seeing shares of Abercrombie & Fitch falling nearly 3.5% in the pre-market, despite the retailer raising its full-year sales guidance following a stronger-than-expected quarter at its teen-focused Hollister brand. It's the second straight quarter the retailer boosted its revenue outlook. Investors are not impressed. And Taylor Swift's getting her own Super Bowl-sized ring from Kansas City Chiefs tight end Travis Kelce. If you haven't seen, the pop star announced their engagement on Instagram yesterday, and the news of their impending nuptials sparked a flood of online bets on a possible wedding date and when the couple might have a baby. That's your Bloomberg brief. John?
Yahira, thank you. Appreciate it. Is this going to spark a load of marriages across the country now?
I think I saw people online celebrating as if they got engaged. Huge media coup for the couple.
There we go. Up next on the programme, I just don't care. I know other people do. It's a feel-good story. I just can't. I'm happy for them, all right? Up next, we'll set you up for the day ahead. Plus, Troy Gayeski of Future Standard's going to join us on this market as we count you down to the opening bell and the main event later on this afternoon. From New York, this is Bloomberg.
I wish there was a more intellectual appeal about the Fed's role as opposed to coming with bogus charges. This is more about his effort to exert control over the Fed because I think they're concerned that their trade agenda is causing great weakness in the labor market, and they want rates lower. And to be fair, this is what the president has always wanted, is lower rates, even when he had the option to appoint Jerome Powell in the first administration.
That was Marc Short, the former chief of staff to the former VP, Mike Pence, on a programme a little bit earlier. In your market right now, as we count you down to the opening bell, about 42 minutes away, equity futures pretty much unchanged on the S&P 500. On the Nasdaq 100, negative by close to 0.1%. We've had some outperformance on the small caps, bit of underperformance this morning. We're down by 0.2%. Turn to the bond market. Intriguing moves at the front and long end of the curve. On the month so far, 30-year bond yields at the highs, 2-year bond yields at the lows. The difference between the two, 130 basis points. That is the widest going back to late 21, early 22. That curve is getting steeper and steeper by the day. We'll come back to the bond market in just a moment. Let's get to the day ahead as we count you down to that opening bell at 1 a.m. or 1 p.m. Eastern time. The U.S. Treasury is auctioning $70 billion of 5-year notes after the market close. Nvidia earnings on to Thursday, another round of jobless claims, and on Friday, core PCE plus you mentioned consumer sentiment data coming up a little bit later. As we look ahead to those Nvidia earnings after the closing bell, Troy Gayeski of Future Standard writing, Nvidia's results are hugely important to the market in order to validate the continued growth of AI spend. Joining us now to discuss is Troy. Troy, welcome to the program. Big earnings event later on this afternoon. What are you expecting?
Yeah, so there's no reason to expect any dramatic underperformance or disappointment. Markets have already brought down forward revenue growth expectations. But, the big picture here is, we're in the midst of one of the greatest business fixed investment booms of all time. And this year alone, about 55 basis points of additional GDP contribution will come from just the 4 hyperscalers and Apple. And next year, that should be about 40 basis points of additional spending on an over $30 trillion nominal GDP. So the importance doesn't only go to the actual capital markets in terms of justifying these multiples and current valuations, but also that we're going to continue to have this tremendous growth tailwind that helps reduce recession risk and drive higher GDP than clearly we would have otherwise, John.
Troy, we continuously hear, though, that the big question mark heading into the earnings today is going to be about China. How are you thinking about NVIDIA's access to that market?
Yeah, I think that's obviously the wild card in, markets. You hate to say we'll look past that, but that's an uncontrollable variable. What you see going forward, though, from the four hyperscalers is clearly more spending. And obviously, NVIDIA has a borderline monopoly on that market. So, the multiple, I would much rather the multiple be 25% lower than it is today. I mean, the whole hyperscaler complex, what I refer to as the Fab Five, you have four companies spending like crazy. One company's the beneficiary. Those multiples have revalued fully, which is the biggest danger for markets today, in that if there is disappointment, there's more downside versus, say, 6 to 8 weeks ago, when whether you looked at Meta or Google, even NVIDIA at that point had a more rational multiple. So things are priced to perfection, but the AI spends, NVIDIA's earnings go far beyond just market conditions and really spill over into the broader economy.
Troy, if they're priced for perfection, is just coming in, bang in line enough, or do they really need to outperform this evening?
Yeah, I think it's continued to be, as long as there's marginal outperformance, it doesn't have to be blockbuster outperformance like we've seen the past few quarters. I think markets will digest that well. Doesn't mean there's material upside from here. It just means that we're set up to have a strong Q4. In a different outcome, if they disappoint, then you're going to have a series of questions that are raised again about what's the ROIC on the AI spends, when are the hyperscalers going to start to not necessarily cut back, but cease to grow at these meteoric paces. And so in terms of that number, if it's disappointing, then you're going to have a lot of questions of whether or not we can finish the year with strength. In the short term, though, it'll take quite an exceptional earnings number to drive higher upside from here.
Troy, can we just turn to this push to go private that we've seen emerge? Massive for the month of August. We saw this with Soho House just last week. Seeing it again this morning, Danny was talking about the prospect of it happening with Canada Goose. Troy, what's happening? What explains that shift from public to private?
Oh, look, so we've had this tremendous transformation of the U.S. economy over the last 20, 25 years, really starting with Sarbanes-Oxley, where you created a real disincentive for companies to be public. And over time, as you had this substantial capital inflow into private equity and private credit behind it in order to finance a lot of these companies at roughly a 50 LTV, it's really stunning that, 96% of the companies in America that have 100 or more employees are privately held, right? And we've always thought the sweet spot of that is the mid-market, somewhere between 10 million and $1 billion of revenue. That's not changing, right? It's slowed down during post-Liberation Day. There was a lot of financing being lined up, a lot of enthusiasm about mergers. The brakes were hit, but that's expected to come back in really dramatic fashion in Q4. And we're seeing it, in our credit businesses where, a lot of the capital we're lining up to finance certain situations are really focused not just on private to private transactions, but continuing that mega theme of public to private.
Troy, it's good to hear from you. As always, Troy Gayeski there of Future Standard. Seen a lot of those moves take place over the past month, and maybe more still to come in the months to come. Coming up tomorrow, big lineup for you. Dan Ives of Wedbush on NVIDIA earnings. We'll catch up with Stuart Kaiser of Citi, Geeta Gopinath of the IMF, and Matt Stuckey of Northwestern Mutual. We're going to catch up with Lisa tomorrow. She's going to drop by going into the weekend just to get her thoughts on what's happening with the global economy and the latest developments in this bond market as the pressure continues to build on this Federal Reserve.
Absolutely. The pressure going to be continuing to build, Jonathan, but so everyone knows it is going to be a long slog depending on what happens at the Federal Reserve. There's going to be a court battle that shapes up. And as soon as this week, we're probably going to get this injunction from the governor. And that will basically tell us whether or not she'll be there in September voting for a rate cut or not.
Well, there's two different things going on here. And I think we have to keep referring to the two different things. One is the president's ability to fire a sitting Fed governor and the reason he has for it. And the other, ultimately, is the allegations of mortgage fraud. We still don't have an official investigation open up on that. We still haven't had an official denial from the governor, Lisa Cook. Some people might have sympathy with the fact that there still isn't an investigation. But ultimately, you'd have to think that if the evidence was there at some point in the next few weeks, she's going to present that internally to the Fed chair. And if she isn't able to do that, do we end up in the same situation that we were in a number of years ago when some Fed officials had to step aside?
Exactly. There are two different paths, but they might all end up at the same place, which is the fact that this becomes untenable for her to continuously serving, and she has to resign because of not just the pressure, but she's not in herself, her own capacity, able to fight this case. And a big question is going to be whether or not the Fed really comes out in her defense. Because right now, all the Fed said is like, we are going to abide by what the court decides.
You've described how awkward it might be on September 17th.
So
You might have Governor Lisa Cook still there. Stephen Myron, current CEA chair. It could be confirmed by the time we get to that.
He might be confirmed. We reported last night the Senate banking hearing is going to move quickly in terms of his hearing because they're starting it next week. His hearing, though, is going to be an absolute referendum, at least for the Democrats, on Fed independence.
That hearing is going to come up very shortly. Annmarie, this was fun. It's good to have you back in the seat.
Thanks.
Let's turn to the markets as we count you down to the opening bell about 35 minutes away. Equity futures on the S&P 500 shaping up as follows, just about unchanged as we wait for earnings from Nvidia. As we often repeat, it makes up 8% of the S&P, 10% of the Nasdaq 100, and the enthusiasm across the whole sector and beyond will be shaped by that one name alone later on this afternoon. In the bond market, a few things to look out for. The move at the front end compared to the move at the long end. At the very front end of the curve, yields are lower by 3 basis points. At the long end, higher by 3 basis points. 495 and climbing as we approach that line in the sand and get closer to 5%. From New York City, thank you for choosing Bloomberg TV.